Welcome to the macro report. We're going to take a look at before we hit the charts. Let me turn that down. Before we hit the charts, we're going to take a look at the actual jobs report, kind of what the market is starting to price in. And what we see is, it was a pretty strong jobs report. The market is selling off currently, and this is the target rate that the market is pricing in. It's pricing from yesterday. It actually increased the chances of a rate hike given this economic data. So let's dive into that really quick. Let's see. Let's take a look at that. We got ISM. See where we at. We are Thursday. Yeah, here we are. So first we had the S&P. Or I'm sorry. First we had the ADP. So this was a big blowout. This is the ADP private payrolls. And you're basically seeing, scroll down a little bit, you're basically getting a very explosive move. So, hard landing, soft landing, jobs are coming in. The jobs market is bidding higher. It's extremely strong right now. And good morning. Good morning. How's everybody doing? We had this is the first part, by the way. This is the first part of the jobs report. Tomorrow's the second half, and the S&P is selling off. Right now, stocks are selling off pretty hard, and we're going to go over why the macro forces are tightening the economy because of this, or tightening financial conditions, investment conditions. Excuse me. But anyways, the ADP private payroll. So this is this is going to probably signal how strong payrolls come out tomorrow. So that's pretty strong. Jobless claims. So jobless claims kind of fell a little bit. Nothing too significant, but they did fall. Right. Jobless. Let me zoom in. That jobless claims fell a little bit. So that's coming down a little bit. But for the most part, yeah. Look at this. Let me turn this into an actual. And if you're on TikTok, check out the YouTube channel if you want to see the actual charts. Okay, so this is the private payrolls data. I mean, I guess it doesn't look that great on this chart because of that big drop from the pandemic, but for the most part, we are looking a lot stronger. And then we just got the S&P. So first things first. Well, we did get the JOLTS report too, job openings. First things first, the labor market is strong. It is starting to expand also. So it's starting to strengthen. We're getting more strength in the labor market. And right now, the bond yields. So if we jump over here to bond yields, look at the reaction from the bond yields. A 2-year rate, right? 2-year interest rates just hit a 52-week high. Well, really, this is like a 7-year high. So we actually climbed in rates for the bond market. They did come back down, but this is the highest we've seen for the 2-year. So short-term rates are extremely elevated at this point. The 5-year also jumped to the previous high. The 10-year still lagging behind, but it is breaking out. So we're getting rates started from the bond market. The interest rates from the bond market are really starting to rip higher, and that's what's pushing down the stock market. So we can see here, if I go to the S&P, we got a gigantic gap down, right? Look at this big gap down. We gap down pretty hard. It doesn't look that bad from here, but this is a pretty big move to the downside, right? We had that big gap up. We came back, filled the gap. Looks like we're going lower. And let's kind of finish off on the reports. What else did we see here? What else is going on here? Good morning, Spike Dodgeball. So also we had, let's go to the JOLT job openings. So what do we see on job openings? Coming down. So this is tightening up the labor market. That's a good sign, because you're getting that labor, you're getting no wage inflation. That's the good sign. Yes, people are coming into the workforce, and they're going to keep spending. So spending is going nowhere. This is really signaling that spending is going to continue, that people have enough jobs. As a matter of fact, we're adding a lot more jobs than the market anticipated. So the recession is kind of off the table at this point. The recession is not on the table. And it looks like, yeah, there was a big gap down there. Recession's off the table. I still think we find support given that, the recession fears are off the table. It's really those bond yields, right? The cost of capital is pretty much exploding. Now, if we go to the services PMI, this is also important, right? The PMI, we're still elevated. So we went from, and services PMI is just, remember, there's manufacturing. We have the manufacturing sector and the services sector, and we're seeing that the manufacturing sector is declining. The services sector didn't necessarily decline. We're still above 50. We're still in expansion territory. So services are still strong. And given the actual report on employment, I expect that to continue. But we did now. What did we do? We did from this was the PMI also. This was the global services PMI. So why is it not showing up on here? That's weird. Should be showing up here. Services PMI 54. Either way, we're going to look at the ISM data. The ISM data is kind of the benchmark data for the US, and the ISM data shows us that we are still expanding. So services bounced, right? Services bounced. That's a strong indication that, yeah, manufacturing is declining, as we said, the rolling recession, but services are starting to move higher, or back up above 50. So they're expanding. The economy is pretty strong. That's what that tells us, right? The last read was at 50, and this one's at 53.9. That's a strong jump. So we are getting strength in the labor market, specifically from the employment. And we're going to go a little deeper into that also. ISM, now this is where's the prices paid? That's the big one. Did we get prices go higher, right? This is prices paid right here. This is good. This means no service inflation. No service inflation. You're getting prices paid come down. So although the service economy is expanding, the prices, right, the supply side prices or the wages, not necessarily wages, but supply side is coming down. So that's a positive, while the new orders are picking up. So the economy is actually starting to expand, right? That's a good thing. It's starting to expand out of the recession narrative with prices coming down. So no inflation. Now, the bad part is that the bond market is guessing, not the bad part, but the downside to that is that the bond market is tightening up. So we get, 10-year yield. This is really the benchmark rate. We're always going to keep our eye on this. This was a big move from the 10-year yield, right? The cost of capital benchmark rate is exploding. And that should be moving the dollar up too. And we're seeing the dollar start to climb. So this is risk off. This is the macro forces that we always talk about. These are risk off conditions here. So we're going to find out if the strong economy if that narrative of no collapse, no recession can push the stock market higher, or are these tighter conditions just too tight, right? Is it too tight? We also have oil going nowhere. So that's good. That's in our favor. Oil's going nowhere. The VIX is starting to jump. And I think this is we got to look at the bond volatility. VIX is starting to jump. So risk off here. A lot of people are making that bet. Bond volatility is nowhere. So that's good. We're in good territory there. Everything looks good for the most part. Yeah, this is a big risk off move. Going back to the economic data though, job quits really didn't go anywhere. So, oh, I'm sorry, job quits are up. Okay, job quits are. It was the challenger job cuts that are down. So job cuts are down. And what does that tell her? What does that tell us? That job cuts are down, meaning, people aren't extremely offloading employees. That unemployment rate should come in not very bad tomorrow, right? Should come in pretty strong. I'd say it's going to be coming in around 3.8. It's at 3.7 right now. So, yeah, business activity is strong in the services economy. Wow. ISM services back to 60. And if we look at the trend, that's okay. So it's back to above trend. So services are pretty much strong. Now let's turn to the actual market, because what we're getting there is, okay, the jobs report is very strong. And that's why we see the not futures, but the expectation for a rate hike is up now. It is up now. So it's going to take inflation really to come down next week for the Fed to pivot. So the market is expecting another rate hike, right? And it actually might be pricing in a rate hike in September now. Let's see if that changed. Okay, not exactly. It's not pricing in another rate hike, but definitely okay going out. So the market's pricing in a higher probability of rate hikes coming into the market in the future. And that's going to be the big difference there. Good morning, guys. How you guys doing this morning? Let me see what we got. What stock should I buy? Pierce, what stock should I buy right now? Say to trade for the day trade. I mean, you got to know how to trade. I would never say buy a stock to trade, because there's too many variables. There's a lot of variables. There's never really, there's stocks to invest in going forward, but to trade, that's it. I'd say this: if you have to ask me what you should trade, you probably shouldn't be trading at all, because you should have a strategy on how you're picking your stocks, what you're actually looking at. and the levels. I can point out setups. It looks like we're going to have some downside setups today, but for the most part, anything to trade in the day is going to be very, you're probably going to lose, man. 90% chance that you lose. But if you're looking 6 months out, there are some longer term, plays that you can make. A lot of people don't want to wait. They don't want to be patient. But the 6 month out or anything a little longer term is going to be good. I think the SPY does bounce here. So we're going to take a look we're going to take a look deeper into the market. Let's make sure we went through all the data there. We also have some Fed speak, right? Fed Logan, who was talking about the balance sheet, and we will go over that in a minute. Let's see, what else did he talk about? This was okay. This is about an hour ago. 10-year yields are starting to rise. Yeah, let's take a look into the market. Let's dive a little deeper and see how the market is starting to sell off at this point. We'll switch up this, switch this view up. There we go. All right, so S&P, right? We sort of double topped at 440, 444. It's responding extremely negative. And that's because, like I said, the dollar is starting to pick up, but the dollar's picking up because rates are rising. The cost of capital is starting to rise. And that's because the expectations for inflation are now higher. And I don't think it means inflation goes up. I just mean that the expectations for inflation to remain sticky are now at a high, are now elevated because the more payrolls you have, the more people are going to spend. I still think the market finds a bottom at some point, and so we'll dive into that a little deeper. Let's see what we're getting with the crypto market. Is it responding a little bit? It's not too bad. Didn't have such a big gap down, so crypto's still holding on there. I know Bitcoin was up early this morning. It did have a pullback, little risk off, but it got up to 30. It made a new high this morning, and then it ripped down after the report. Okay, so crypto somewhat correlated to that. You're getting that MicroStrategy pullback. Okay, cool. Palantir back below 15. Yeah, Palantir back below 15. Let's now move over to the actual intraday fundamentals. Not fundamentals. Let's move into the intraday, see what's going on. S&P 500. Okay. And I'm going to put on here the 30-minute chart. I'm not going to throw TOS on yet. Let's look at that. See that gap? That gap right there is basically the reaction. That's the pre-market reaction from the employment report. And I don't even think the employment report was so terrible because it does signal no recession. So yeah, that was a break of trend there. But what it is signaling mostly what it is reacting to is the bond yields elevated, bond yields going higher. That's what it's reacting to, right? The cost of capital just went up a lot. That could change over the coming days, but we'll see. How about the Qs? How bad did the Qs gap down? They gapped down right into support. So we gapped right into that previous support. We could be, forming a bigger trend here. I thought this was good because the longer that we consolidate at these elevated levels, the bigger that wave 2 FOMO is going to come out. And I think it's going to be set off by inflation expectations dropping, right? So it's kind of tricky because you have the economy starting to expand, and you'd think that that'd be a good thing, which it is, but the market is now pricing in higher rates, higher for longer. And I think we just need to find a base and to go higher. What could really throw us over if these bond yields continue to rise, then maybe. I'm doing good. How you doing, Slime Z, this morning? Yeah, we got a big gap down. So this is the market reacting to good news, negative to good news. So what is the main culprit for that? We're going to go deeper into the actual ADP report too. I'm going to look at that on the side to see what's going on here. We'll listen to Wall Street, see what they're talking about. But for the most part, yeah, that's what we're looking at here. I'm going to throw the pre-market back on the screen so we can see exactly how those assets reacted. So yeah, big pullback, and then we had previous support here. What was this? 365 for the Qs. Okay, so the Qs are starting to find a little bit of support here. Don't know if it lasts, right? Maybe it doesn't last, but the Qs are finding a little bit support in the intermediate early morning. Let's go to that 1 minute. Okay, we're finding a little bit of support on the Qs. S&P looks very weak. The S&P looks a little weaker than the Qs. ARK really sold off hard. Apple's sort of consolidating. Nothing too wild here on Apple. Microsoft, let's go through this way. Consolidating. Google's down. Netflix selling off pretty hard. Amazon 128. So Amazon's still consolidating. Meta's still consolidating. They came out with their Threads. Tesla. This is the pullback on Tesla. This is what I've been hoping for. I hope we don't break out yet. We need to pull back a little more, right? So a lot of people shorting Tesla at this point. It's always a good short if you get that momentum to the downside, right? Just the way it rips higher, it rips lower also. But on the bigger time frame, I don't think it goes, below 250. 250 might be the bottom. 260 is that next resistance level, somewhere around 260. We could get there today on Tesla. We'll see how that plays out. But yeah, for the most part, the market is reacting pretty negative. Open Door came right back down to fill. Came back down pretty quickly. But yeah, I think stocks are going to find support here. AMD did fall out too. AMD fell out hard. This was a pretty strong pullback on AMD. Came back to 110. Now it's now starting to bounce. It needs to get above the pre-market highs. Actually, I'm going to throw on the actual trading desk to see what these are really looking like intraday. Anyways, what questions do we got here? What stocks do I buy? Yeah, no stocks to buy. Let me see. Hold on. What is this? Well, that's weird. Okay. Yeah, there's a lot of buying opportunities here. Hey, Isaiah, come check this out really quick. Check this out. I don't know where this is coming from.
Oh, it's a fake account.
Oh, okay.
Yeah, just click on X's logo.
Wow. Dang, they got some bots on here. Never know. All right, so yeah, let's dive into that. We're gonna go into the actual. We'll see what's actually selling off and where the opportunities are at. Maybe I will stay on this because we can see a little better the macro. I'm gonna go to the 30-minute chart. Okay, 30-minute chart, and looking at AMD. AMD. Let's remove those pre-market so we can see the actual trend here. There we go. So AMD is still in this uptrend. It's still holding. It is actually at risk of breaking this uptrend. And I know there's sort of a bear flag. It couldn't get above that level. And you just got to stay tuned. We need to get back above 111 or 112 for AMD. And that's going to rely on the market starting to bounce here. I think the Qs are going to bounce though, right? Let's look at, if we look at the overall market, where's our next support? Our next support for the Qs is 365. Right, let's take a look at this, 365-ish. I would say, yeah, that was where our previous resistance was, and now we're starting to support that area. So we do have to hold 365 for the Qs to remain bullish. If not, then we'll come all the way back to that support line, and that is the Qs. IWM, whoa, IWM had a hard sell-off. Wow. This was a pretty strong reaction to the downside. I'm surprised. I'm actually really surprised that we sold off this hard on data that suggests the economy is strengthening, right? The economy is actually strengthening. So it's going to be those bond yields and TLT. That means that TLT is definitely, yeah, this is what's going on here, guys. This is really, is it really that negative? I don't think so. I think the stock market will find its legs. And this really points to the fact that we might see yield curve control from the Federal Reserve or from Janet Yellen from the U.S. Treasury. This is the bond market, right? This is the bid on bonds. We talked about this yesterday. And basically, what we're seeing is that nobody wants to buy bonds because the economy is now starting to strengthen a lot. And if that's the case, why own a bond that's going to yield you a certain percentage guaranteed by the government when you can basically get that same yield from a money market fund with no volatility, right? So, or the other case is just buy stocks, right? Stock market's going higher because the economy is, and the stock market's been calling this out, by the way. The stock market has been up since October, signaling a stronger economy. And so far, it's been right. When we look at the labor numbers, right, labor market numbers, the housing market is starting to bottom, and we're seeing that that the economy is strengthening. So that's why I always say the market is smarter than us, and it is definitely signaling. It's been signaling the last 6 months, since January, 6 months pretty much, that things are going to improve. And that's exactly what we're seeing. So we're seeing a sell-off in the actual holding of bonds, right? Bonds are actually getting smashed. And what that does is it pushes yields up. So can the market survive high yields? Not if yields keep climbing. If yields keep climbing, we're going to need an intervention from someone from somewhere to buy these bonds, right? To get things back down. And it seems like a lot of the foreigners are not going to be doing that. They may not be doing that. How can I get started? Become a better understanding in macro TA. Your lives and video account help a lot, but I want to learn more. Yeah, I would just start with if you're looking at the macro, like technical analysis. I mean, I do it all the time, but I would stick with looking at the US dollar, right? And understanding that the dollar is the cost of the cost of trade around the world. If the cost of trade goes up, that's going to cut margins, right? It's almost like when I say trade, it's like purchasing, right? Transactions. So if you're looking at buying something at the store, this is like a tax on the world. This is a tax on world trade. The higher it goes, the bigger the tax, the less revenue, the more it hurts everything else, right? The more the dollar falls, the cheaper it is to trade, and the cheaper it is for other asset prices. So, because everything is pretty much priced in dollars, at least 80% of transactions are done using US dollars. That's going nowhere. So start with the dollar, and then you can look at the benchmark rates, which are the 10-year US 10-year yields, right? US 10-year over here on TradingView. And this is the cost of capital. The overall trend for this has been lower, but we've had things going higher for a while. And these are the two macro forces that I keep my eye on when the macro really starts to turn. There's other stuff you could look at too. Actually, I would read some of the posts that I have, and then you can come in and ask some questions. But I have a lot of macro stuff. Slime Z, if you want to go check it out on mindgrowth.io. Start with, let's see. Let me see. I think it's under economics. First, start with the business cycle. Okay. The business cycle is probably the most important thing first to kind of understand how do this economic growth cycles happen, right? This is just a post on, and you have a lot of stuff here: macro analysis, the business cycle, policy, economics. So how does policy impact the market? Leading, lagging, and coincident indicators, right here for the economy overall: manufacturing versus services, supply versus demand side inflation. Start with this. Go check this out on the page. Start with the macro analysis and then just work your way down. Just learn as much as you can. Read, and you're still going to be confused, but after you read, at least you'll sort of get a grasp of what's going on a little better. And then you can go from there. It is a lot of information, but yeah, start with that, Slime Z. Check that out first, Manny. Go read. You got to educate yourself. That's probably the most important thing. Looks like we're getting a bounce here in the market, though, overall. It looks like we're starting to get a bounce here. I think we do bounce because that's not really bad news. It just means the economy, not the economy. It just means that the recession fears are kind of off the table. They're off the table, and the only thing that would bring a recession would actually be rate hikes accelerating, and then possibly, if they accelerate too much, then we could possibly get a contraction of credit, a further contraction of credit. But I just don't see that happening. I don't know. I don't think that's really going to happen right now because it really depends on inflation. That's a good, it's really the best recipe if you're getting inflation come down and you're getting economic activity pick up. That's literally the Goldilocks. So I think this is more of an algorithmic sell off and a little bit of fear, especially how fast it came down, right? If anything, we're forming a bigger wedge here at these lows. So, you could, like, if I zone in, if I kind of come in here a little bit, I think we're going to be forming a bigger wedge up here, or a channel, a sideways channel. We could be seeing that also. This is SPX, by the way. Yeah, so we're at the bottom of the trend. We'll see. We at the end of the day, we got to hold for 4,300, or not 4,300, but 43.25, whatever this last support zone is. We got to hold that to fully get this move going. So that was a huge sell off, but it's just, it's literally, it's a little oversold. It's extremely oversold. All right, now let's see who else we got here. Yeah, check out oil too. Add comments. Yeah, you can add comments to the post also. You can add comments to the post. So, okay, so we have that initial negative reaction. I am keep my eye on these treasury yields. Are they going to keep climbing? So, as just so you know, FYI, we'll do a little education here, and then we'll go into the market because it is selling off right now. I think it's going to find a bottom. At this point, when you see the US 10-year treasury spiking like this is literally, people aren't buying this. What they're doing is, this is a function of selling bonds. That's all it is. It's a function of selling bonds, or of people dumping their bonds because they're like, oh goodness, the economy is strong. Why hold bonds? Stocks outperform when the economy is stronger, right? The expectation of the collapse of the recession is not happening, so let's buy bonds. And so now bonds are starting to spike. I'm sorry, let's sell our bonds and buy something else. So we're going to figure out where that rotation is going into. Is it rotating into gold? Nope, gold's going lower. Is it going into Bitcoin? Nope, not exactly. Where it's going is it's going into cash. Look at the dollar. The dollar is going up. So that's one macroeconomic concept, is people are fearful, but they don't even know what they're fearful of yet. Most of these are algorithms. And what they're fearful is, why would we hold bonds when so they're selling their bonds and they're going into dollars. Dollars are starting to elevate, but nobody's going to hold the dollar because we're not going in. There's no real geopolitical risks, right? The dollar doesn't yield you anything unless you park it at a money market fund. So, and still, that's not as good as the return on the stock market. So I think we shuffle into dollars for a little bit, and then as the market digests the report, remember, we still have more coming tomorrow. We still have more data for the labor market tomorrow, right? Tomorrow is going to be just taking a look in there. Tomorrow is going to be non-farm payroll. So that's going to be the real, the real benchmark payrolls data. It's probably going to come out stronger than expected, especially after that private payroll data came out. Then we have unemployment, right? I think we have unemployment. I wouldn't even doubt if the market goes right back to where it was. I really wouldn't doubt that, because to me, this is really strong data. This is really good. You're getting prices paid lower. You're getting wage inflation or supply side inflation lower. And you're seeing the economy really start to expand in the services sector, especially, right? Payrolls are up. People are going to keep spending. How is that negative? That isn't negative. I think this reaction is a little overdone. Of course, we'll get some more data tomorrow. So the recession fears they're leaving the table, right? The recession fears are leaving the table, and we're not getting like oil explode either. We're not getting that. So the dollar is rising. 10-year yields are rising because people are selling their bonds into US dollars. And really, I think we're just looking for the bottom in the S&P now at this point, right? Are they going to buy the S&P? Are we going to find support in the Qs? Is it going to be in crypto? Is it going to be in IWM? Is it going to be in the Dow? No bottoming yet. No bottoming signal yet. So we will look at that. So that's what we got going on tomorrow. Now, the Fed did speak a little bit, so we can check out what they said. But before we do that, I'm going to let's switch these charts up. Let's go ahead and hit the actual trading window. See, where's my trading window at? There we go. And then we'll read the stories on the CNBC, what they're saying. Oh, that 1 hour wedge on SPX. Yeah, it'll start to form a little bit. All right, so here we go. Here's S&P on the left-hand side, or on the right-hand side. Why did Bitcoin dump? Bitcoin dumped just in reaction to the higher yields. Basically, the labor market report this morning, the jobs report came in strong, extremely strong. So no recession, right? It doesn't mean no recession, but what it means is like the expectation of a recession continue to drop. And because of that, people sold their bonds off because you buy bonds into recession. So they sold their bonds. And when you sell bonds, when the price of a bond goes down, the yields on those bonds go higher, and the yields represent the cost of capital, which is the cost of borrowing. So really, at the end of the day, it means the cost of borrowing went up. The cost to borrow went up. That's basically what the market is selling off on. And the dollar kind of went up a little bit too. All right. So we're looking to see if the S&P can find support anywhere. I mean, this was a very sharp sell-off. What's going on here? Like what is the big why so hard, right? Fed Logan, we also had some Fed speak. So I'm going to pull that up on the side while we have the charts up here. I'll keep my eye on the left-hand side. Okay, so AMD is finding a little bit of support. Take a look at Tesla because I still think this is the best play long term. I don't think it really matters what happens in this noise. Tesla is now pulling back and trying to hold that previous low. Maybe it fills the gap. This would be perfect. If it comes back down and holds the gap, if you're not long already, this would be a perfect entry point, is down here on the support of that gap. Man, IWM's getting crushed. Also, advanced decline. I have this in the left-hand corner. You guys can't really see it, but we're at negative 2,000. So almost every single stock in the market is, we got a news update. What, anything? No, that was something else. Almost every stock in the market is selling off. They're declining versus more stocks are declining. Over 2,400 stocks are declining versus advancing. Okay, but I still think this is a nothing burger. You got the VIX exploding. It could just be some relief. It could be relief going on here for the downside. It could be downside relief. Dow selling off. Or maybe it's the beginning of the top. Maybe this is the top, right? Maybe this is the top and we're going to roll over. I don't think so, but that's also a possibility. The Q seem to be finding a little more support faster than the S&P 500. All right, so I'm going to keep my eye on Tesla here on the left-hand side, and then S&P. Yeah, you're welcome. All right, yeah, Tesla finding a little bit of support at that previous level. Could sell off a lot deeper, of course. All right, so I'm going to keep that on there, and then I'm going to go to read what the Fed is saying. What Fed Logan said. He came out this morning, one of the Fed members, I believe. I'm not sure if he's voting or not. But what is it? Dude, what is this? Get out of the way. Oh, New York Fed President Williams was speaking also this morning. Let's see what this guy was saying. Yeah, we'll go back on that. We'll figure out what he's saying there. All right. So anyways, while I keep these up, I'm going to read what the Fed said this morning. A couple of the comments to see if any of them are actually important, right? Did he say anything different that we haven't already seen? So we got Logan and Williams speaking. All right. So Fed Logan, the Fed balance sheet outlook shouldn't affect the rate outlook. Okay, great. The Fed's balance sheet. I guess they're going to keep selling it off. Treasury account rebuild likely to come from overnight reversal. See, now they're admitting this. Remember, we talked about this. We said that the whole bearishness on liquidity, which is the drain of the treasury, not the drain of the rebuild of the TGA, the Treasury General Account, the rebuild, which would suck liquidity from the banking sector. That risk is off the table. Even the Fed is now how would I say this, acknowledging that liquidity is coming from the overnight repo, which is them. It's pretty much their liquidity, the liquidity that they built up. The $2 trillion in liquidity is now just going into the coffers of the government so they can spend more. So that's still positive. The housing market may have bottomed. We talked about this, right? We've been talking about that. Maybe the housing market is starting to bottom. And so he's saying that I'm skeptical about lagged impact of past Fed rate hikes. He's skeptical about the lagged impact. So this means that basically, I think this is an argument for the pause, because if we're going to keep decline, or I'm sorry, if the rate hikes don't factor themselves into the economy till later, well, why do you keep hiking then? Because we're going to see that effect, right? So this is kind of a pause argument there. The housing sector rebound might threaten progress on inflation. Okay. So he's saying, okay, if we don't build enough supply, or I'm sorry, the if the housing market starts to boom again, or it might keep inflation a little higher than expected, but I still think the Fed doesn't care as much about inflation being, sub 4%. So like in the threes, I think they can handle 3.5%, 2 to 3.5%, 2.5 to 3.5%. I think they can hold that as long as the economy doesn't collapse. I know other people think they need and want the economy to collapse. I don't think that. So the job market, inflation are both hotter than expected. Okay. Okay, he doesn't see the Fed's balance sheet dynamic. This is where they drain the balance sheet of the Fed. They're basically selling assets into the market, and if you sell it into the money market funds or the banks, they have to buy it so the cash leaves the capital markets. They're saying that shouldn't affect the liquidity pressures because they got the reverse repo that's pushing liquidity in anyway. We are skeptical on the large consequence of rate hike lag effects. Okay, yeah, of course. Tighter credit is due to tighter policy, not bank stress. So the tighter credit is literally just the fact that they raise their rate hikes means that the interest for banks to loan, because remember the Fed funds rate at 5.25, which is supposed to go to 5.5, 5.25 to 5.5. That is for overnight borrowing for banks, not for us, for banks, right? And so what happens is, well, the banks, if their rates are higher, then they're going to lend. They're also going to lend out at a higher interest rate. So so people are going to be turned off. That's too high. So he's just saying the banking stress is from the rate hike. So they control that. They can relieve the system if they needed to. More restrictive policy is needed for the FOMC to reach their goals. Okay, well that's counterintuitive. More Fed hikes are likely necessary. So now he's getting a little hawkish here. Uncertain environment. See, they just keep going back and forth, man. They're okay. Well, things might fall apart if we keep this up, but we should keep this up. So I think they're just literally not. Who knows what's behind them? But they're full of crap. I would have been okay with June rate increase. They're saying nothing, man. They're just saying nothing. They're all repeating the same thing. There's no dissent. There's nobody coming out and giving their real opinion. Maybe Bostic. He's been the only one to call for a pause. Very concerned to whether inflation will cool quickly enough. Okay, that might be something to be concerned about, because if it stays elevated, then rates stay elevated, right? If inflation comes down quicker, then they can cut rates or they can stop hiking, which I think they've stopped hiking already. I've seen no sign of abrupt worsening in the labor market. Yep, that's true. That's what we're seeing. Yeah, I don't think there's nothing new here. The only thing that we're starting to learn that we've talked about already is that the labor market is definitely stronger. The VIX is spiking off this news. Goodness, the VIX is going up. But that's a good problem to have. The economy is not going into recession. The VIX is going up. Okay, so no economic crash. Now it's all that really pushes the risks towards inflation being higher, right? Because that's the real risk is, okay, well, if the economy is not collapsing, then we anticipate inflation is going to be up. So if inflation comes out low, like I said, next week, I think that's going to be the true catalyst to break us out to wave 2 FOMO. Maybe not, but I think it is. I think it is, because right now there is no recession. Okay, there is no recession. It's not happening. We're not seeing that. So the ISM supply side services went the service economy, right? Given the economic leads, which is the ISM PMI services, those are expanding. So the economy is expanding in the services sector. No recession. Oil demand growth has oil is the big risk here. I saw OPEC or not OPEC or whatever. They're trying to cut more production. So I still think the biggest risk is going to be oil climbing up. Yes, bonds are getting murdered, Bukowski. Yes, they are. Bonds getting smashed right now. And that's why rates are up. What up, Broken Testicle? Moving to the woods. That guy's funny. Yeah, I gotta have my gotta get these back out. Anyway, shout out to the chat. Yeah, shout out to the chat. I gotta get this working a little better. Still waiting for these technicians to email me back because the Stream Deck doesn't work with the Mac OS. That's dumb. It only works with Windows when it comes to the actual soundboard. It's all right. We'll get it fixed. Overall, the banking system is strong. Okay. Yeah, this is all, but to me, it's still bullish. I think this is just a bearish pullback, a quick little pullback that'll get bought up. Everything is coming in strong. Everything looks straight. You know, maybe I'm 100% wrong, but the reports are really good. The reports are Fear and Greed Index 77, Extreme Greed. That could be it. I think people are getting extremely bullish, and that might be the reason for a pullback. Is just there's a lot of bullishness in the market, and that usually that sentiment causes a pullback. Not back to the bear market, but definitely a pullback. Definitely a technical pullback. So I think that's what we're just seeing there. Here goes Tesla. S&P still struggling. Let me get back to the chart here. S&P is still struggling. And I'm going to go over some CNBC stuff too. We'll see what they're saying. Bank of America upgrades Sweet Green. Oh, okay. That's not a macro report. Let's see what the macro report says. I don't know if there's any good macro reports. Bank of America expects more stocks to participate in the market rally. Yep. Rolling recession, rolling recovery. That's Ed Yardini. We went over him yesterday. Wow. Tesla's pushing off that level pretty strong. Right. Really strong for Tesla there. Too much good stuff in the pipeline. Dang. Bank of America Securities raised Tesla's price target to 300 from 225. This is like 10 minutes ago, so that could be the push higher for Tesla. So Bank of America, hey, remember we talked about this yesterday. I said for Tesla, a lot of the times you get this wedge pattern that looks like it's going to break out. It doesn't break out. It breaks down, makes a new low, right? It makes a new low, and then it gets bought up and it just rips higher. So I'm expecting this could play out that way. Do I want it to play out that way? No, because I need some more time, obviously, for my option that I'm selling against Tesla. I need it to be a little lower. I don't want it to leave without me. I don't want to be sad, but that is the case. That is the case right now for Tesla. Is that it's extremely strong and probably will be the best performer of the mega caps after Meta. Still watching AMD down there in the corner. All right, so what else updates do we get? I know Tom Lee has a lot of stuff that a lot of macro stuff that he puts out every day. He's always putting out stuff. Watch for that Bitcoin breakout. Hey, this might be the chance to get in. Well, not for anybody else, but this might be the opportunity for MicroStrategy. What is it? MSTR. This might be it. We're getting a pullback finally. This thing got to 391. Goodness. I was looking at it back here at 310 or 312, and it just kept going. It was up 22%. And if this thing goes, it's a huge short squeeze, has a 30% short float. So that alone is going to squeeze the stock higher. And if Bitcoin keeps rising, well, it's going to go much higher than that because they own a bunch of Bitcoin. Definitely want to see a bigger pullback there, though. Okay, so SPY still selling off here. YouTube stream looks great. Thanks, I appreciate it. YouTube link in your webpage. Your residence, I'm pretty sure my YouTube link is literally on my bio there on TikTok. The YouTube link is there if you guys want to go check it out. Unless you're asking me to add it somewhere else. Oh, on my webpage, the YouTube link on the actual webpage, the Mind Growth website, maybe. Appreciate you guys though with the support here. Shout out to all you guys. Let me get to these comments here. Yeah, bonds are getting smashed here. All right, yeah. So we're gonna keep up. I want to hear what these guys are saying. I want to see if anybody knows what is going on or what is the actual issue here. Bounce back a bit. Fed Williams. I want to hear this Fed speakers talk a little bit. This was yesterday, Fed Williams. I don't know if this is even relevant. I really don't. So anyways, yeah, MicroStrategy, I'm definitely keeping my eye on that if it rips back a little stronger. I mean, if it has a stronger pullback. But Bitcoin right now is strong. I think over the next 12 months, I know a lot of people doubt crypto, but I think it's the best performer for sure. Right? I think crypto's going to be the best performer. It's just a matter of time before this thing breaks out again. So it tried to get above the big level this morning. Couldn't do it because rates rose, right? Rates started to rise again. Inflation is going to be that next catalyst for sure, in my view. So yeah, in the short term, dang man, the VIX rose pretty quick. Let's take a look at the VIX really quick because the VIX has been at a 2 or 3 year low for a while. So this was a pretty big move for the VIX here. Right. Yeah, we came all the way down to, and I think this might be it. This is the relief. This could be just the relief rally for volatility. It's been suppressed. What was this? This was 2020. So the VIX got down to levels from January 2020, right before the pandemic. And we could just be witnessing, okay, a lot of people are bullish, and now the sell orders come in. Right now, everybody's offloading, like, okay, let's get out of here on this new report. I think it means nothing. I think we're going to find a bottom and go higher. That's just my instinct, is that this is not this is just a relief. This is just a small relief, but that was a big move on the VIX from 12 to 15%. Maybe you short it here. No, I'm just kidding. There's so many things you could do. I wouldn't be shorting the VIX. It's a little too difficult. Unless you specialize in that, I would just get long something that has good fundamentals, right? Good balance sheet, good margin growth, good guidance, good a very good macro setup. Okay, so VIX volatility. What are we missing here? What does the trend look like for Microsoft? Microsoft still chugging along here. Okay, the Mind Growth site. Okay, I'll let my brother know. Thoughts on SPY from here back to 442 today? Probably not today. Hey, thank you guys. By the way, thank you guys on TikTok for the suggestions. I appreciate it. And yeah, hey, come check out the YouTube. Come subscribe, support me if you can. Charts are a lot better here on YouTube, but just go give me a sub. I'll have videos on YouTube. I'm gonna start making more longer form videos, so you guys can check those out when they do come in. So yeah, Microsoft is still strong. Like nothing happened to Microsoft, right? Microsoft is still holding up here. Why is that? Because I think this was just a nothing burger. Apple had a little gap down, probably an opportunity to actually buy for a lot of people. Meta, same thing. Look at big mega cap isn't going anywhere. Big mega cap wasn't even affected by this jobs report. It's extremely bullish because I think it's just extremely bullish, and you're getting some sort of just relief rally. The greed index is up a lot. So that could be it. NFLX, Netflix pulling back, given an opportunity, right? As it forms a bigger look at Netflix. Netflix might actually be forming. I mean, I guess you can't call it a wedge because it's not perfect, but it is starting to form a channel here, an opportunity from Netflix, given that gap up. Man, Netflix has been up so much. I need some hot coffee for my throat. Trying to recover. All right. Qs are getting rejected in the short term. We're getting a rejection on the Qs. Let's see what else we got here. Rejection on the Qs. Netflix looks solid though. I like Netflix right now. Netflix is looking pretty good. I wouldn't get into Netflix. I just don't like it personally. Not that I don't like the service, but the price action I'm not a fan of. It would have to really rip lower. I just think there's better stuff to get into, and I'm going to get into what I know and what I like and where I see another catalyst. And now Tesla, nothing, right? We're not getting a bit. This is really just the overall index pulling back. S&P and the Qs. That's it. That's pretty much it. S&P and the Qs right back to those lows. So 437. Just trying to make sure we have this correct. Very sharp pullback, but not a whole lot of movement on the, not a whole lot of downside movement on the mega caps. So what does that tell you? That the index just got a little too elevated the last couple days. Look at this. We've moved up so quick. Last couple days on the index, it consolidated, came right back down. So I think that's what it was. Is sometimes you get the actual Qs and the SPY move up, and it doesn't really bring the market higher. It's almost like just the indexes are being traded, or not the overall market. So I think it just basically deflated this morning. That's all I can see, because really you look at mega cap, it's going nowhere. The FANG is still carrying things. But if you do go to ARK, if we do take a look at ARK, which is the innovation fund, it is getting smashed. It got hit pretty hard too. So who else got hit? Probably Zoom. Tesla didn't get hit, but Zoom got hit pretty hard. Yeah, Zoom is breaking down. Unfortunately, Zoom is breaking down, making new lows. Didn't even look at the big monster Nvidia. Nvidia is setting. Oh man, Nvidia is actually really setting up here. Let me go to the daily chart here. This is a good setup for Nvidia. You're still above all-time highs. You're still holding. Now you're starting to get a bigger pattern starting to form. You get the lower high end. As long as it continues to support that 400 level, I want to say 4,000, but the 400 level, as long as it supports that, you have this consolidation, this triangle, or even a wedge consolidation. So we'll see how that consolidates. Because if this thing gets tighter, the tighter Nvidia gets while it holds 4,000, that's a bigger opportunity for some upside. And I think it's going to continue. I think we should still see some more upside. I don't see that going anywhere anytime soon. The only reason that I haven't been too excited about Nvidia is because it just went up so much so quick, and there's a lot of FOMO. So time spent above the level is really good. You want to see time spent above that level. And maybe we consolidate sideways here before it starts to flush up again, right? And this is the assumption that the market keeps going higher. And I think that's the case because all the macro points to a better market. The fundamentals are starting to improve. By the way, fund managers are not fund managers, but analysts are starting to increase the earnings growth, right? They're increasing earnings growth expectations or estimates. And because the payrolls, the job, the spending data is better than feared. So what do you do? What do you do? I really think we're going to get a bounce. I really think we're going to get a strong bounce here at some point. Maybe it's not till the end of the day. Maybe it's midday. Unless we have some geopolitical stuff that I'm missing. I don't think so. I don't think I'm missing anything here. Obviously, I could be because I'm not a. Yeah, so we got that going on there. I'm going to turn this back into a trader style. There we go. All right. Anything from CNBC? I think that's it, man. Just driven by higher rates and higher rate expectations. Oh, what up, Fibonacci? Ace, what up? What up, Ace? What's going on? All right. So yeah, let me see on Twitter if there's something else. I'm gonna double check. The ADP doesn't matter yet. The bond market reacts like this. I thought the bond market was supposed to be smart. I don't know what's going on with the bond market. What I do know is this could be the final flush because there's a all-time high short positioning in bonds. So maybe they cover here. Maybe they cover and this was it. They might cover tomorrow. They might cover tomorrow. But I think this big downside move just is coming from higher bond yields, right? The bond market is getting sold off. And so if it gets sold off, then rates go higher, but we'll digest. I mean, that's a good thing. It's not terrible. The problem is there's not a big buyer in the market right now. Usually it's the Fed coming in with their Fed balance sheet. That's exactly what the Fed's balance sheet does. It buys US treasuries to keep rates lower. So the fact that they're selling their treasuries, right? The fact that they're unloading the balance sheet is takes away the bid for bonds, which also, takes away the cap on rates. So at some point, I expect them to cap rates. I've said this before, and maybe we get it at sometime this summer, which is that the U.S. Treasury, Janet Yellen, has mentioned that she wants to buy bonds. Right? They even though they are the ones who sell and create the bonds, they want to actually start buying back the old supply of bonds, and which should push rates lower. And if that's the case, then we're going to get yield curve control just like we saw in Japan, or just like Japan does. Japan actually does that yield curve control. Their government buys back the bonds to keep the rates lower, to cap them. That might be exactly what we're headed for. Wow. All right. Yeah. So that's what's going on there. ADP payrolls report. I'm going to dive deeper. I'm going to take a small little break, and then we're going to dive deeper into this ADP's report as we watch the indexes. But first, yeah, I definitely need to get the Stream Deck. All right, I'll be right back. The dumpster fire. Okay. All right, we'll take that off. Yeah, I got to get me some hot coffee. I was drinking some cold coffee, but it didn't work. Didn't work, man. Well, Tesla's grinding up from this position. Tesla 272 is the low. So that ADP's payrolls report. Also, what are they talking about here? What do you guys think about the new Instagram threads? I know that's the big thing. I'm hearing that they're just pretty much starting to copy. They're just copying Twitter, right? Completely copy the code. Who is this guy? I want to hear what this guy's saying here. Okay, I agree with this guy. I know he's a CNBC guy, but it doesn't matter. You got to agree with the logic. And what he said here on CNBC is basically okay. So his 3 points: unless job growth sparks inflation, it's good for stocks, and that's what I'm saying. I think this is a buy the dip. I know we ripped lower, but this is a buy the dip, and I don't mean literally go buy the dip on anything. Obviously, you want to have the the best asset class is not the best asset class. You want to buy the best plays over the next 12 to 18 months if you're investing or swing trades, and you want to do that. You don't just want to buy anything. Obviously, Tesla, in my view, is one of the best stocks. I like AMD. I like Zoom ain't doing too well. I do have some leap calls on Zoom. I got in way too early. Bitcoin, So either way, I think this is going to be buy the dip. We're starting to double bottom here on the Qs. And he says, unless job growth sparks inflation, which, it's good for stocks. The market is worrying that the Fed might tighten into a recession, because it's all expectations here. If the market is, I'm sorry, if the Fed tightens because the labor market is strong, then they're gonna actually get the recession going, because they're gonna keep tightening rates, which is dumb. I really don't think the Fed is that dumb. I know a lot of people think that. I don't think the Fed is that dumb. I don't think they actually want to tighten because the labor market is strong. That's nonsensical. It's just to keep expectations. I think really when you tell consumers that inflation is going to get worse, or that recession is around the corner, I think people spend less. It actually has that psychological effect where inflation actually does solve itself because of the fear of recession coming around the corner, and also prices going lower. If prices are going lower, why would you start buying big items now? You're going to wait, right? You're going to wait for houses to come down. You're going to wait for refrigerators, for TVs. You're going to wait for car prices to drop to some degree, whatever those goods are. Maybe you keep spending in the services economy, which is exactly what we're seeing. That's not slowing down. And so yeah, I think this is a really. And the reason I'm talking through this, because the market doesn't agree with me currently, but I still think it doesn't agree with me in the intraday. But we'll see how that plays out. Big mega cap tech is not going anywhere, though. Big mega cap tech didn't even really sell off. Really didn't. We're seeing riskier assets sell off that don't have the best balance sheets. I think that's what's going down, because those higher rates will affect them, right? You still want to have a strong balance sheet. So maybe a really good dip buy right now. I'll say this outright: Palantir under 15. I think that's the best risk reward right now over the next 18 months. The AI play, AI is not overdone. Look at Palantir is just forming a beautiful. I hope this thing forms a wedge, a dragon wedge, right? So if you are in the YouTube, you can actually see this on YouTube. Check this out. I'm not going to talk about my position in Palantir, but I will say this: if this does form a bigger wedge here, come on, tool work, right? If we come down like this, and from here we see something like this, right? If we see that start to form, and then we break out of that wedge while the market finds its low, Palantir is going to rip. They have a great balance sheet, no debt. Revenue growth is very strong, right? They are part of the AI. Like everything you want in a good story, it's there. Everything you want in a solid story, it's there. The problem is most people don't understand how AI works. So they just pick the lowest price. They're like, oh, this company is AI and they're only $1. Okay. So they don't really understand that. But for the most part, Wall Street hasn't even bought into this. There's actually not the risk, but there's the catalyst that Palantir gets put into the S&P 500. But they need a couple more quarters of revenue beats or EPS beats for that to happen. I think you need like 4 quarters straight to beat EPS or to actually turn a profit before they put you in there. And when they did it with Tesla exploded. So keep your eye on Palantir. This is definitely not financial advice, but I think Palantir is one of the best opportunities you can get. I know it's up a lot, but it's just getting started, especially at the bottom of a bear market, or when you're rolling out of a bear market, inflation's coming down, blah, blah, blah. We talked about this 1,000 times. Either way, I agree with this guy on CNBC when he says that. Why do people say we're in a bubble or AI bubble? Most of the time they missed out on all the AI stuff. They just missed out. They're angry They're pissed off. They want to compare it to 2001. People, I didn't even know people really get pissed off in finance I didn't realize people were this religious about views. They get really pissed off if you're bullish on something they're bearish on. They get really upset because your money is kind of tied to your well-being, right? Your money, you worked hard for it. And so if somebody threatens that, just like religion or politics, all of a sudden they're freaking out. It's like, bro, just have an objective view on it. But AI bubble, there is no AI bubble. The bubble hasn't even started. You haven't even seen IPOs come out yet. Only the big tech companies are the ones who are using AI. Plus, AI is not even new. That's crypto is still newer than AI. AI has been around for a while, so it's not new. It's just the next generation of AI that we're starting to see here, generative AI, and then we're going to see Internet of Things, where everything is connected to the web, like your house, your refrigerator, everything's connected. Everything's basically a mobile device. That's coming next. Who knows how soon, how early, whatever. But anyways, yeah, Palantir. I like Palantir. Just wanted to point that out. Which cryptos are in AI? There is no crypto AI, by the way, just so you know, Spike Dodgerball. When you guys hear crypto AI, it doesn't exist. There is no crypto, has nothing to do with AI. Crypto is a closed system, right? It's a closed system, and the smart contracts, AI needs so much data. I don't know how to explain it best. My brother could explain it better. But just put it this way, uh, AI and crypto don't mix. They can mix, but right now it's not. There is no cryptos that are AI cryptos. That literally doesn't make sense. It's all FUD. If you do hear it, I remember they try to push the graph as AI crypto and it exploded. It's not. There's no AI cryptos. It's a bunch of crap if you hear it, and they're just trying to get the coins up. But there's no AI crypto. It doesn't exist yet. Because it just doesn't like. I'm not a computer scientist or engineer, so I can't really explain it that well. But I've heard it explained, and no, it doesn't make any sense. It just doesn't make any sense. There's a couple ways it could make sense, but nah, there's no crypto AI. People just use the buzzwords. Anyways, yeah, what are we looking at here? What am I doing? All right, so need uptick inflation, pull back to turn. So you really, yeah, you need a real meaningful uptick in inflation for the pullback to turn into a downturn. When I say that here on the left-hand side, right, let's look at SP. Should we look at SPY? I know I have a lot of stuff charted on there. Now let's look at the futures /ES. These are S&P futures, right? So for this pullback to really turn into like a rollover, so we roll over and we just start trending down. You need an uptick in inflation. I keep saying this. You need a real uptick in inflation. Inflation has to move up, not sticky. It has to move up to get a true bear market, to get us right back into the bear market. Now, if it's sticky, we could just be moving sideways for a while in a choppy area. That I think that's what is more likely. If inflation's stickier, maybe we just turn sideways. You sell some options, right? You just play the sideways action. But I don't think that's the case. I think we're going to see inflation continue to plummet. And really, August is going to be the key. Maybe September, it gets sticky again in September. And when I say sticky, I'm talking about the bounce in oil. Because every time oil goes up, expect inflation to drop less or to rise in that component, right? The energy component. It's all about oil. I'm telling you, it's all about oil because shelter is going to come down. We know shelter is going to come down. They're building a lot of supply, even though you hear there's not enough supply of houses. I don't know, maybe in some areas, but overall, I think those prices do come down. Commercial real estate's already set to roll over. So, like in general, shelter prices, I think, just continue to go lower into 2024. Maybe they don't bottom till early 2024. I've heard a couple people talk about that. See, what do we got here? Yeah, so that's what I'm looking at. I think that's kind of the case that we're looking at. Let's hear what else this guy has to say. You know what? That reminds me, there's $5.5 trillion in cash on the sideline, according to some research from Tom Lee and a couple other people, which tells you on these big pullbacks, as long as once people like they're like kind of fearful, like, oh shoot, the S&P is pulling back. And then as soon as they get that confidence, like, oh, okay, everything's cool, the Fed's not going to hike again, or, we're not heading into recession, they start buying the dip. So I really do expect that. I expect that to play out going forward. Is you're going to see some real dip buying. Is it going to happen right now? Maybe they buy at the end of the day because we have seen these end day recoveries happen lately. We've been seeing a lot of these end of day recoveries. Um, yep, crypto projects. Yeah, crypto still. I mean, man, the S&P is looking weak. It is looking weak, and so do the Qs. Where's the bottom at? We got to find the bottom here. VIX is still, dang, VIX is at 17. Goodness, what a rally. What a rally in the VIX. Over 18, that's where you get a little concerned. 18 to 20 is like that magic number where you're entering back into a volatile environment. And then above 20, it's like, okay, there's something risky coming into the market. I'm trying to find it. I'm trying to find, is there something we're missing here? I don't think so. I don't think so. That's why I'm here. I'm trying to make sure, but maybe. What up, Dimaj? I don't know. I really don't know. Okay, so yeah, looking over here, ADP. I want to see if there's anything in the jobs that can give us a little more insight. The jobs data. There we go. So we added the most jobs in natural resources and mining, construction. Look at that. Those construction. I'm not showing this, but construction added a lot of jobs. Manufacturing lost jobs. Remember, we're in a manufacturing recession, so that makes sense. Transportation, utilities, and trade went up. Information down. The information economy for services lost jobs. Financial activities lost jobs. That makes sense because information technology, we've been saying this, tech has been in a recession, right? Technology is in a recession right now, not the stock prices, because the stock prices are nobody cares about the stock. The prices in the recession, the economy is not the same. There's a economic recession in information or in technology because of all the cost shedding, because a lot of people lost the jobs. They're getting rid of their jobs. This is the services information side, right? But the actual stock, if you're an investor, you're like, okay, you shed a bunch of jobs and you can still run your business. Well, that's more earnings for me. So that's why that dislocation happens there. Financial activities, well, rates are higher. So, you see Goldman Sachs, Morgan Stanley, a lot of these banks are also shedding jobs because they don't really need them. They're implementing ChatGPT to take care of a lot of the knowledge work. Professional and business services are down. Education and health services up. This is now leisure and hospitality have been gaining the most, right? Leisure and hospitality, hotels, Airbnb, and I'm just kidding, Airbnb is getting crushed. Leisure and hospitality have the most job gains by far. And what does that tell you? That consumers are spending, right? They're going out to restaurants, they're having fun, they're traveling, they're doing what they want to do, and they're not buying goods. So that is pretty much what we're seeing when it comes to size region. Let's look at the region. What about regional? Does this give me regional data? Oh yeah, this isn't regional. National. Yeah, private payrolls have been skyrocketing. We're above we're above trend when it comes to after the pandemic. We're right back above trend. So US employment is strong. Yeah, I just want to keep nailing it in the coffin. Like, hey, employment is strong. Employment is strong. It's not falling off a cliff. So it doesn't mean go buy the dip. It just means don't overreact to the downside here. Don't get caught in all this fear mongering from just the market selling off in a short period of time. All right, so again, the dividends, yeah, there's a lot of dividends being paid out. Dang, that's crazy. A lot of dividend reinvestment. You also have a 401k bid. I always say this, like, there's more buyers in the market overall. We've been in a recession for a year, and you have people's retirement funds still buying S&P, right? You got the dividend reinvestment, which I didn't even think about coming into the market on a casual basis. Is the inversion. Okay, here we go. Jeff DeGraff. I really like this guy from Macro Renaissance. I want to hear what we listened to him yesterday. I guess he's on again. He is on again. But some of these dudes have, really good insight that I've never thought about. So I like to do that. I like to listen to all of them. Some of them are just repeating the same thing, but definitely want to hear what this guy has to say. If you are on YouTube, I'm going to throw that link up there. And then I'm going to switch this up. There we go. All right, this is Jeff DeGraff. Let's hear what he has to say.
If I just take a step back and look at yields from a technical perspective, it looks like they're going higher. So I do have to be mindful and respectful of that. But is it a disaster? Is it 5% or 6% or some of the big numbers that are out there? I don't think so. I think it's probably somewhere around 425. But at that level, some of the work that we've done with our yield impact model, et cetera, does start to push against the S&P. So that would be some concern for us.
Joining us now, Richard Bernstein, advisor, CEO Richard Bernstein. Richard, great to see you. How much of an issue is the 10-year yield being above that level, 4%, and also the climb in the 2-year, which of course makes it more difficult for the parts of the market that bulls have been citing as, it's good news that, for instance, small caps are finally participating, while a higher 2-year yield makes it very difficult for small caps.
Yep, Melissa, good morning. I think.
Yep, those small cap companies, the higher yields go, the higher the cost of capital, the less funding they're going to get, which is why we see IWM struggling so bad. IWM had a big gap down. Mega cap, big FANG, Apple, Amazon, Google, Facebook, they're not really selling off that hard. The Qs aren't making a huge, the Q sold off, but it's not that big of a sell. I guess that was a pretty big move, 5 points, 6 points. But those individual companies are just not doing it because, the high rate environment isn't really going to be that effective, especially when people want a return on their money. They want a good, solid return. And, you're not going to bankrupt FANG. You're not going to bankrupt Apple, Amazon, Google, Facebook, Tesla, blah, 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 right? Meta. You're not going to bankrupt them because rates are a little more elevated. It's just not going to happen. So people are selling out. Now, this might rock us a little bit because what I'm also noticing here is we might get that market breadth start to disappear. So this could be a knock-on effect. Honestly, when we do look at the overall market in general, right? Hey, is that coffee ready? When we look at the overall market in general, or not the overall market, but when we look at the macros, right? 10-year yields being this elevated, that was one of my risk-off theses, which is if we get yields back to the highs, then I'm going to have to slow down. So maybe I need to take that into a better perspective. When I say slow down, I'm saying like, okay, the bullishness needs to slow, but I really want to see the inflation numbers because yes, labor is stronger than expected, but that's not the main culprit. The main culprit is the actual inflation data. So if the actual inflation data, and this looks like a huge bear flag on the Qs, the actual inflation data needs to show or reinforce that inflation is coming back, right? Stickiness, whatever, but coming back. And I just don't think that's the case. I bet you we're going to get a bounce by the end of the day. I bought calls today. Dang. Would you buy calls on?
I think your point and Jeff's point in that previous clip is very important. When you're essentially investing on companies that have very long time horizons, right? Whether we're talking AI or we're talking the metaverse, we're talking cryptocurrencies, anything that has a very long time horizon, upward trending interest rates is not what you want to see, right? We're talking about long duration events far out in the future. You want lower interest rates, not higher interest rates, if that's your investment theme. So Jeff's absolutely right.
Okay, so look, to simplify this for some of you might understand this already, but risk assets, Bitcoin, even Tesla, a lot of the big tech, not all the big tech, because some of them are just monsters, but a lot of the companies who don't have the best balance sheets, they're looking far out into the future. That's why their PEs are higher, which is why I always say, who cares about PE? It doesn't matter when the Fed cuts rates. It doesn't matter when liquidity comes back into the market. So what this guy is saying is the reason why risk assets like ARK are getting smashed, ARK Invest, because they hold a lot of innovation technologies who need funding. They need funding. They're not generating revenues, right? CRISPR is not generating revenues. SoFi is not profitable. A lot of these companies are not profitable yet. So when they rely on lower interest rates to get funding, because the lower the interest rates, the more risk somebody's willing to take. And so that's why their PEs are higher. Their earnings are way into the future. So if you increase the cost of capital, the 10-year yield, right, it's going up, it's elevating. Like, dang, is this thing going to come down? As that cost of capital goes up, well, investors feel uncomfortable holding that stock because they're going to get less funding. It makes it harder for them to keep their growth up, and it puts them at risk. What it also does is it puts at risk a lot of the regional banks. Because the higher the rates, well, it depends how they're managing their books, but the higher the rates go, the less demand they're going to get for lending, right? The less demand. And also, if they do own US treasuries, which is really why this might accelerate another banking crisis. If this continues, if we get yields, remaining elevated, this could restart another banking crisis, which ultimately you guys already know means more cowbell, more stimulus. What it means is that the bank's collateral, they buy US treasuries. So if the US treasuries, right, if the US treasuries are falling in value, the bank's collateral, these regional bank collateral are also falling in value. If their collateral falls in value, they become at risk for liquidation or being insolvent if it falls too far, right? Especially with rates elevated. So if we increase rates again to 5.25 to 5.5, and then also the US treasuries fall in value, I think we see another crisis in banking. Look at KRE. Let's take a look at KRE. That is the regional banking ETF. And bear flag, man, you want to make a trade. KRE is bearish as all can be. Wow. Yeah, KRE is extremely bearish. I know I'm not showing this on, check this out. You guys on YouTube, check out KRE. Oh my gosh, I can't even get this right. There we go. So check out KRE, right? Look at that big bear flag today. I think this really puts the most pressure on these regional banks right here, these elevated rates. So maybe that's the bigger risk, because we're looking for the risks here, right? We're not just like, oh, okay, well, the labor market being strong is good. It is good for stocks. But what are the looming risks here if bond yields keep going? Regardless, bond yields are going higher. So yes, overall, stocks are going to be in good shape, but from going to the lows. But these elevated bond yields, can they cause a bigger issue here? And I think they can. And I'm just trying to be realistic. I am super bullish on the market, but I always say, hey, you guys are going to know when I'm bearish, or not bearish, but when I'm like, hey, something's wrong here, right? Something is looming. And look at the KRE. If this breaks down, this is a huge head and shoulders. If you guys know, KRE is showing a head and shoulders on the, man, somebody needs to signal this, because this looks like this could be the next small little crisis, or what the market is really concerned with. KRE breaks down. If this head and shoulders breaks down, we go back to the lows. Well, that means regional banks are going to start collapsing again. Ultimately, it means more BTFP, right? More buy the dip, because Fed prints more liquidity. But in the short term, this could be definitely an issue. So KRE selling off, right? Forming a head and shoulders, breaking down. We know yields are going higher, so that puts stress on them. We know treasuries, their collateral is going lower. That puts more stress on them. So that will lead to maybe a loss of deposits. Is it deposit loss? I think it just leads to they need to borrow more from the Fed window. So ultimately, we might get the Fed's balance sheet start to expand again a little bit, which is ultimately still bullish, right? But definitely it's good to know these risks and when they're making their way into the market. So keep your, and look at up there, have BTFP, Bank Term Funding Program. That is Fed liquidity straight up. So KRE is at risk of rolling over. Even in the day, even in the intraday, it's forming a huge bear flag. Huge bear flag. And if rates keep going up, I'm going to put rates on the T, it's TNX. I'm going to put rates on the right-hand side. Look at rates. Rates are just climbing. Yep, rates are still climbing. This is 10-year yield rates. Our 10-year yield still climbing. The higher this goes, I think that KRE is going to break down. It's going to break this bear flag. That could be a nice swing trade. I'm not going to lie. That could be a nice little swing trade there. Playing this head and shoulders, at least back down to 38. KRE. Perjure. Yeah, the camera. I have the charts on YouTube. If you want to go check out the YouTube, that's where my charts are at. Can't show both at the same time. So if you want to see the charts, link in the bio. There's a link to my YouTube in the bio. Go sub if you want to support also. All right, yeah. So KRE is breaking down. Wow. So there's our risks. That's our risk right there. KRE breaks down. The market gets a little more worried. The VIX keeps going up. The banking, and that's going to be bad for the Fed. But you know what it does also if KRE breaks down? What does that also mean? This is why I'm still bullish. It also means, okay, if KRE breaks down and we get another banking crisis, do you think the Fed's going to be more willing to hike rates? No, they're not. They're going to keep the pause. If anything, it's going to cause them to cut rates. So this elevation of bond yields could just accelerate the cutting of rates at the end of the day. It could just accelerate that. The more yields go higher, so either way, right, it's buy the dip. Either way, it's buy the dip when it happens. The question is how far, where's the actual dip? Where's the bottom? Not exactly, but how far can we go here? So we're keeping our eye on these risks. And definitely, we just found it. KRE, right? Regional banks are, is there any news in the regional banking sector? I guess this doesn't really give you that much news. They keep saying the regional banks are strong. We'll see if that Fed window keeps opening up. If KRE collapses, the collateral is definitely going lower. All right, so yeah, there it is. Keep that in mind, guys. We'll keep that in mind. KRE, regional banks, interest rates being too high. And that's our next risk here. If bond yields continue to climb, we'll see what happens. All right, let's hear what this guy has to say. We'll continue here.
You've been a critic of that tech, particularly the AI run-up that we've seen, even calling it, I think these are your words, a bubble at this point. Is this what finally breaks that bubble? Is that what finally, breaks, people of the notion that this is a defensive area, that spending in this area will happen no matter what is going on in the economy?
Well, I think, Melissa, first we should rule out that, bubbles pop. It's always very dramatic to say that a bubble is going to end in like a day. It usually takes months, if not quarters, if not years, to dispel the notion that whatever the theme of the bubble was is dead. So I don't think we should think that this is going to happen in a day or a week. But in terms of the other thing I would point out is AI may be, and I would argue will be, a larger part of the economy. That doesn't mean that investing in AI stocks is a good investment. If you go back to the internet bubble in 99 and 2000, certainly the internet became a monstrous part of the economy. But if you bought the internet stocks in December of 99, which was 4 months before the peak of the bubble, it took you 14 years to break even.
Yes, that is true. But the problem is we're not at the internet. We haven't been in a... He's talking about buying the top of a bubble when literally we're at the top. We are not at the top. We're at the very bottom, right? And also, number two, the internet, the .com stuff was fairly new. Just putting .com at the end of your company was fairly new. AI is not new. We've had machine learning since 2012, deep learning since, 2016. And now we have generative AI. So it's not new. It's just iterating, right? It's just iterating. And also the biggest AI plays are in the big mega caps. They're completely safe. So I'm not saying this guy's wrong. He's just kind of spinning, the backdrop and kind of how to look at it. But for the most part, we're not even at the top, right? There is no IPOs yet. I keep saying that. AI bubble. We're starting from a bear market. We're going up. and we're definitely not
So I don't
we're definitely not in bubble territory yet. So when we get there, then hey, you know, it might be in a bubble. We'll see how it goes.
think this AI story right now, people are investing in it saying it's okay, I'll break even in 14 years. No, that's not what people are thinking. But I think we have to separate out the story from the investment opportunity.
That's interesting. I mean, it's a period, Richard, that you know extremely well. Does it mean that you're also against buying at least the picks and shovels of the moment?
So Carl, I just think that there are better long-term stories in other parts of the economy. Look, if we can all agree that globalization is starting to contract, then I think the story in the United States moves from the themes that I like to call cute wiener dogs in the metaverse to real productive assets. The United States is going to have to become more self-sufficient. We're going to have to rebuild the capital stock in the United States. I personally think that's going to be the story for the next 10 to 15 years, not cute wiener dogs in the metaverse, AI, all these other things.
Right. I noticed, correct me if I'm wrong, lowest U.S. exposure in the history of the firm. What's making up the rest?
So let me
Let's listen to that. We've been talking about this. These fund managers are underweight stocks. And you see how he's so negative. AI is not the AI. You should, just because AI is a future doesn't mean stocks. You should be in the stocks. He's trying to make the case to not be long. He's making the case not to be long right here. And he also compared us to the AI bubble. That tells me this dude is not long, right? And I've been telling you guys, or we always mention that a lot of people who are bearish, they're bearish because they've missed the rally. They've completely missed the rally. And not only that, but they want to be bearish on the rally. And I guarantee if AI comes back down or if the market comes back down, they're buyers. Well, we saw it at a better PE, whatever, XYZ. So they're just not in the, they're just definitely underweight. And this guy is the most underweight he's been, whoever he is. He's the most underweight he's been for a while. Now he's laughing because he sounds stupid. And that's totally fine. I mean, hey, maybe you have a good reason to be underweight. He's hoping these yields go higher. But it's just funny because, you know, people's bias, if they're obviously I'm long, right? I'm long AI, I'm long crypto. So I'm going to be biased, but I know that I'm biased. And I know what the risks are, which is, you know, the risks are going to be regulation. The risks are going to be that they do not execute on their projects. You know, and I always say, don't just buy any crypto. I'm not advocating that at all. I'm just saying, you know, if you are going to own this new technology, buy it at the bottom. Technically, that's why technicals are important. You want to own it when it's, you know, Warren Buffett, when things are fearful, you know, get in it, but get in the right things too. You don't want to be in some crappy Pepe coin or blah, 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 or buying some EV company that hasn't proven itself because they could fall apart. Tesla's proven itself, right? That is definitely the best EV play that you can see, or that's on the market. By far, it's not even close. Anyways, point being, this guy's underweight stocks, and this isn't just him. This is sort of a, let me go back to the intraday. It looks like we're getting a bounce on the S&P. This is kind of a reflection. Ooh, nice bottoming pattern there. Okay, now we're getting a bottom here. If you're trading SPY, we're starting to get a bottom here. Let's go. Point being is that he's not the only guy short. He is not the only guy short. A lot of these guys are still underweight stocks, which is why I think we're going to see wave 2 FOMO set off by inflation expectations falling on the next report. The next 2 reports might be the worst report, or might be the best inflation reports that we see, because they, you know, the base effects. We should see, honestly, July, I think we're going to see low 3s, possibly 2.9 inflation, possibly 2.9. Low 3s. I mean, if oil would have dropped out, for sure 2.9, but we'll see how that actually plays out. Either way, the narrative is still here. These guys are underweight and they are going to buy the dip, and they're sitting here on TV saying, oh, well, the AI isn't. Why would you want to buy it? What? Why would you want to invest in AI? Say that it's great, but not buy it here. So you're going to wait till the market's at all-time highs before you start getting interested in you know, finding AI plays, which is Microsoft, Google, Amazon. Who else is it? Meta. Like, you're gonna wait then? That makes no sense. So that's why he's laughing here. I think he's just laughing because he knows, like, hey, we messed up.
I noticed, correct me if I'm wrong, lowest U.S. exposure in the history of the firm. What's making up the rest?
So let me step back for a second on that comment, Carl. When we formed RBA in 2009, one of the reasons we actually formed the firm was we thought we were entering one of the biggest bull markets of our careers, and we had so much in equities, in U.S. equities, that people would not invest with us. That they were sure that the United States was such a terrible place to invest. Well, here we are, 14 years later. And everybody says the only place to invest in the United States. Meanwhile, fundamentals outside the United States are getting better. Look, if you want earnings.
That is true. Fundamentals are getting better outside the US. We talk about this every day. Every day. Japan stimulating, China stimulating, Brazil stimulating, German stock market's up, India stock market's up. So globally, things are starting to rise, and that does correlate with the S&P 500. That does correlate with crypto. It does correlate with overall market breadth as far as the globe. Are we getting complete market breadth in the US markets like IWM? No, because rates are still a little elevated, right? By the way, AMD is also breaking out. I don't want to, let me not talk too soon, but I think this is a buy the dip. I think we're seeing that buy the dip opportunity. Yes, the Qs are starting to bounce. I'm going to put the charts on in a second. If you guys want to see it, throw it in the comments if you want to hear more commentary or hear charts. I just want to get a quick little read on what people are feeling, but I'm gonna keep listening to this guy and respond to him.
Earnings momentum. You want estimate revisions? The strongest estimate revisions in the world are in Europe right now. If you want a reflation story that might take shape, I mean, jury's still out, it would be Japan. I mean, there's lots of different things to think about. There was an article today about Northern Europe and their mineral deposits and things like that. There's lots of different stories going on around the world, but people aren't even looking at what's happening around the world.
How much does the dollar and the strength in the dollar play into this view, Richard?
So Melissa, of course, if the dollar is super strong, that hurts non-U.S. returns, of course. I don't think we should expect the dollar to be super strong here. I think we should expect it to be flat or maybe down. And so in 2 out of the 3 outcomes, probably non-U.S. does reasonably well here. Obviously, if the dollar's weaker, that makes it a better story. But as long as you don't see a screamingly strong dollar, non-U.S. I think is a viable alternative.
Richard, good to see you. Thank you.
Yep, I agree. We want to see the dollar, and remember, crypto is part of that non-U.S. It's not U.S. So the dollar moves sideways. I said this before. If the dollar moves sideways, stocks can keep going up, or risk in general can keep going higher. If the dollar breaks down, risk is going higher, as long as it's not a deep recession. But the dollar wouldn't drop on a deep recession. A deep recession, dollar goes up because people sell their assets, worried about the recession, bonds go up. So we're not seeing that. So for the most part, still good, little setup. It looks like the S&P is starting to bottom here. Before we move on to another story, I will jump over back to the charts here over on YouTube. If you want to join us, subscribe, help me get the subs up. If you think I have pretty good content, subscribe on YouTube. Again, if you are part of, if you are on, damn, I can't think right now. I'm sorry, that coffee is hitting me. I should be able to think better. If you are on Twitch, no, I'm just kidding. If you are on, dude, I really can't think here. I'm having a brain fart. Hold on, where's my thing at? This will clear me up. Stupid. All right. So if you are on the other chat that I cannot think of the name of this for some reason, TikTok. There we go. If you are on TikTok, that's called switching. If you have to context switch, you have to switch context. Like we're talking about the market. Now we're talking about, comments on these different platforms. Your brain gets really mixed up. So what I was going to say is if you are a subscriber, I will still answer your questions, wherever you guys are. As long as you support me, I will prioritize you guys. Yeah, bro, I got a brain fart bad. We'll go back to the charts here. What's best, a strong or weak dollar for the U.S. market? A weak dollar is always best for risk assets in general. A weaker dollar. Sometimes you get a strong dollar and assets do go up, but for the most part, and we can talk about that. I'll talk about that right now as we go to the charts. Let me go to the charts here so we can see. I'm going to go to the trading charts because we want to see this micro data. Let's go to this micro data here. Boom. There we go. This side. All right. Yeah, look at that. S&P is finding support there at 437. Really, it's 437 and a quarter. We're finding support. We are breaking the downtrend. So here's the downtrend. I just want to draw these technicals. We are breaking the downtrend. And we are breaking this trend. So we broke 2 trends. Next level, 438. If we can get above 438 and above VWAP, I think we just climb right back up. Big capitulation. So, and I'm seeing it over here. AMD is now breaking the AMD is starting to move up a little bit. Unfortunately, Zoom is getting crushed, and I do have some calls on Zoom. I probably had FOMO and made a bad decision. I didn't wait for the breakout to happen. I just bought it before. Even though I still want to add more, it still was dumb. It was stupid. It wasn't the best trade. I just want to reveal that because, you know, people make mistakes. But anyways, yeah, getting back to it, S&P is moving up. What were we talking about before I get? There we go. Yes, I'll put my live schedule on there. I'm pretty much live. I appreciate you guys. I'm pretty much live at 10 a.m. Eastern time, Monday through Friday. And then Saturday, I don't know if I'm going to be live on Saturday. I'm still discussing that with my business partner. If I should go live on Saturdays. If you guys show up on Saturdays, bro, then I will go live. I might just do it early. Actually, I might just start it earlier. I might go live on Saturdays and give the macro report. Really, just, you know, no charts. Just give you an overview of the week, and then looking forward. What are we looking at looking forward? So I'm going to do that on Saturdays, but Monday through Friday, 10 a.m. Eastern. Just so you know, I'm live Monday through Friday, 10 a.m. Eastern. Pretty much every day. Pretty much every day. And the charts are much better on. So if you are on TikTok, go jump on YouTube. The charts are better. You can see the visuals if you want to, you know, see that. If you just want to listen, that's fine. I know people like the TikTok platform because it's kind of like a community. I didn't realize it's sort of like a little community. I thought it was just content, but I think people like to hang out on there. Whereas YouTube, it's a little more competitive, and the algorithm won't give you no smoke, or what do you call it? The algorithm will not promote you on YouTube unless that's really good. YouTube is tough. I'll keep it real. TikTok is pretty easy to get things going. So that's why I say come support the YouTube channel. Help me out. If you think I'm pretty good or give good content, come help me up on YouTube so I can get that algo out so we can push the content out. Tesla's starting to support 275 also. That's really good. Oh yeah, what a pullback. Nice. Anyways, you did Privatas, whatever your name is. Private with no E. What's best, a strong or weak dollar for the US stock market? Yeah, so let's get back into that. Now, I'm going to put the dollar here on the right hand side. Look at rates are starting to rise a little bit. DXY. And then I'm going to close this off so we could talk about the dollar, because really in my big thesis, which is, I think we're in phase 1 FOMO. I think we get phase 2 FOMO, phase 3 FOMO, right? Phase 3, there's only phase 3 is when everything goes, when it's pure, there's no argument. We're in a bull market and everybody gets along. And now it comes down to the macro sort of disappears, and it comes down to what stocks do you pick? Which assets do you pick? Right? That's what we're headed for in the future. The problem with that is that I think you should get in early, right? At least I want to get in early. I don't want to be picking assets at the top of okay, we're back to the S&P's up 30%. Now it's time to buy. What? That's dumb. That's dumb in my view if you're trying to maximize your returns. That could work for some strategies, just not mine. So anyways, back to the dollar. Let's keep a look at the dollar. What are we looking at here? So when the dollar, I'm going to go to the weekly chart here, right? When the dollar makes a big upside move, typically right here, you see it? Typically that is negative for markets, right? So the dollar had a big move here, and I don't think I can overlay here, but when the dollar moves higher, it's usually negative. Not always though. There's little pockets, but these big moves from the dollar are pushing asset prices. Everything is priced in dollars. Your stocks, your food, your energy, everything is priced in dollars. So when the dollar moves up, typically your assets, the price of your assets are going to move down because the dollar is the denominator. I actually have a blog post on this, and it is what is it called? Somebody, well, I would say somebody in the chat, if you have it, go check it out. The macro, what is it? Is it part of my macro? I have a series on this actual macro stuff, so I want to make sure we get that out there. Dollar. It's called the macro force of US dollars. I got to change the title and make it a little more appeasing. But I do have a blog on that, so you can read about how the dollar actually works. It is the world reserve currency. It is dominant. It is called the bowling ball, right? It's the bowling ball because when it moves, everything moves. Right now, it's moving through because of interest rates. There's a lot of principles. So I'll show you that. I'll actually pull that up so you guys can see that. But yeah, when the dollar typically moves higher, you're going to get asset prices at least be in a bear market. When the dollar sells off sharply, so here in what is this? I don't know what date this was, but when the dollar sold off sharply, asset prices go higher. They work they're inverse, but it's not always true. It's just most of the time. It's in general. Obviously, during the pandemic, what did we get? The dollar spiked. And as soon as they started debasing the currency, which pushes the dollar lower, QE. So QE is going to push the dollar lower, just so you guys know. QE, once we start printing again, creating more liquidity and interest rates come down, well, that's going to push the dollar lower and asset prices go higher. So we're in the middle. We're on the edge of the dollar breaking down or breaking higher. What takes it higher is going to be interest rates climbing again, right? I think we're at the end of the cycle. So interest rates climbing would push us higher. If we break down, right, once we get back into QE, the dollar's going lower. It's going lower once we get back into QE. And that's going to be another risk on signal. So keep that in mind. Look at S&P still holding on here. That's good. S&P is still holding on. Oh, you're Swedish. Oh, what up, man? What up? Welcome to the thing. Are you one of the Swedish guys? Are you do you know VP? Are you one of VP's guys? Varian pension? Yeah, you're welcome, MR Manuel always. Yeah, YouTube's a lot better. And I'm gonna get the stream better too, man. I just had problems with this dang Stream Deck and Mac OS. They put a walled garden up here on the Apple devices. They don't want, you know, every application to be able to work for certain reasons. I don't know why, but anyways, yeah, we got S&P starting to move up. Hold on, I got some guests in the building. I'm gonna close the door. Anyways, fire your questions out. Fire your questions out if you want to. You have some more questions here. S&P is moving up. This could be the break of the trend. We'll check out some other stocks and see what else is moving. What else is starting to recover here? Oh, what's going on there? Is this thing freaking out? Weird. Okay. All right. So yeah, now S&P is not out of the clear yet. We still got to get above 438 and VWAP and support VWAP. So we're not there yet. But the advanced decline line is starting to climb, right? So that's good. More stocks are advancing now in the intermediate, but not for the day. The VIX peaked out at 17. The Dow still pretty weak. IWM still pretty weak. It's at 80. Q starting to bounce a little bit. So we may be getting that turn. We may be starting to get that turn. All right. How does ETH to BTC look? Where do you see SPY? Oh shoot, where do you see SPY by the end of the year? Predictions? I see SPY at all-time highs. I think S&P can easily get back to all-time highs by the end of the year if these macro forces come into play and if inflation continues to decelerate or just make progress. As long as inflation is making progress, everything is setting up to go much higher. It really is. That's the reason the market sold off in the first place, because inflation, you know, and you always need inflation, but the rate of inflation was up too much. So we're headed back to those lows. And yeah, I see S&P at least all-time highs. I think for sure the Qs get back to all-time highs by the end of the year. I think that's really. What up, Asset Printer? What's going on? What up, Norberto? Over here, just so you guys know, over here on YouTube, so you can see the charts. If not, you're just listening to the commentary. But I got all the charts on YouTube. It's a lot more efficient. And go sub if you have time. Go sub to my YouTube channel. Help me get the subscriber list up. That'll really support me on YouTube. I appreciate it. Dang, ZM is still selling off. Goodness sake. I'm getting smashed on those calls. Big mistake there. Anyways, triple B spreads also are falling, which is really good. So, I really just don't think that we are headed for, I just think this is an interest rate thing. But of course, KRE is the risk, right? KRE is the risk. But at the end of the day, if KRE sells off again, what does it mean? It means more liquidity from the Fed. They're going to have to pump that liquidity. That balance sheet goes up. And last time the balance sheet went up, Bitcoin took off and the S&P bottomed, and more risk into the market. Plus, they're going to have to pause. Sorry, I'm over here looking at this this other chart over here. All right, let's see if anything new came in. Any more questions? What do we have? What's your view on, or how does ETH to BTC look? Now, to look at ETH to BTC, let's check that out. Because ETH to BTC, I'm extremely bullish on. If you're not familiar with it, is Bitcoin against it's Bitcoin again. Where's oh, okay. No, that's not it. The heck? Oh, there we go. It's Bitcoin against or I'm sorry, it's Ethereum versus Bitcoin. I think Ethereum can outpace Bitcoin here over the next cycle. I think Ethereum can outpace Bitcoin. So here's Bitcoin. Here's the chart of Bitcoin really quick. All right, here's the chart of Bitcoin. It is breaking out. It's been on a monster rally. I'm going to go to the weekly chart. It's a lot easier to see this. This is the big trend of Bitcoin, right? Moving higher over time. And this is the chart of Ethereum, right? Ethereum moving higher. Ethereum is Ethereum is fairly new. They're completely different assets. They're not competing against each other. But if Bitcoin goes higher, generally crypto goes higher, and ETH is that second wave, right? ETH is the second biggest blue chip. It is the blue chip though. There's really nothing else but ETH and Bitcoin. The rest of them are really risky. These two, I mean, people are already using them. Big companies, MasterCard, Visa, they've been using Ethereum for a while. JP Morgan, there's a lot of news here. Now, ETH to BTC, right? Let's check that out. This is Ethereum versus Bitcoin. Look at this wedge pattern. If you guys are familiar with my content, I love wedge patterns. This wedge pattern has been forming, and maybe I'm wrong. Maybe it doesn't break out. It's been forming since June of 2017, right? And we started making new highs the last cycle, but Ethereum couldn't get above, just couldn't get there. If we do break out, maybe we come back and retest. But if this wedge breaks out eventually, actually, I'm going to put it on the monthly channel. It'll be a little clearer. There we go. If this wedge does eventually break out, then what you're looking at is Ethereum gaining dominance against Bitcoin. You're basically getting a better return on it. You're getting a better return in crypto from owning ETH than owning Bitcoin. And once this thing gets up to this level, because right now it's at 0.6, once obviously it gets to 0.1, then it actually is going to be the size of Bitcoin. So if this thing breaks out of here, ETH will be the size of Bitcoin. I think that's very possible. I think it is possible. So yeah, that's the answer to that question. What's your view on Truflation? Oh, I like Truflation. Yeah, Truflation is legit. Truflation is legit. What is Truflation at right now? The Truflation. It's blockchain. There it is, Truflation. So what is Truflation? Truflation is basically a blockchain tracking multiple inflation indications or inflation measurements, and inflation has us at 2.3%. So we're basically at the Fed's target in real time if you trust the blockchain Truflation, which is public knowledge. It's all public. It shows you how they measure it versus the Fed. They don't really tell you. So a lot of people hate it though. They're pissed. They're like, oh no, inflation is much higher. Those people love to believe inflation is higher. They're lying to us about the data. But I think it's just more of this ideological belief that the Fed, the government is always evil. They're always trying to screw you over, which, hey, people that are selfish and companies, you're going to get screwed over if you're on the wrong side of things. That doesn't mean inflation is always higher than it is. Even Pompliano, I like Anthony Pompliano, but he's always, inflation's going higher. It's higher than it is. That's just not true. It's just not true in the macro. When you look at the macro, it's just not true. Inflation is coming down. And inflation is not prices. It is not prices. It is the rate of change of prices. Get that through your head. It is not prices are elevated. It is the rate of change of prices. Well, the stock market goes up, and guess what? It's outpacing the rate of inflation. That's why you own assets that can outpace that. Anyways, small little rant there, but yeah, I like Shrooflation. Paul Alger, all-time highs with possibly 2 rate hikes coming. I don't know, man. Yeah, 2 rate hikes coming in the pipeline. Well, for one, the market's already pricing in. So where's that CME data? The market is already pricing in a rate hike currently. It's pricing in one more rate hike. Okay. So the problem is here, Mr. Paul Alger, the reason I say all-time highs is because you have a lot of catalyst in the pipeline. You have a lot of catalyst to make this, to push this market higher, right? And just remember, the market was pricing in the Fed's target. It's at 5 and 5 1/4, at as high as 5.5 to 6%. So we've been pricing in higher rates for a long time. Now the actual rates materializing has been another thing. That's actually been different. Are they actually going to materialize? I don't know. All right. So to answer your, to comment off you, Paul, I would say that number one, the reason we've got up so much is because of the AI boom. And the reason, first of all, rate hikes are even on the table at all is because of the inflation backdrop. So what are we seeing? The inflation backdrop is actually changing. Inflation is coming down faster on headline than a lot of people expect. So the stock market doesn't really care that inflation is sticky. It cares that inflation is making progress, right? We see that progress. Now, we did hike rates and the stock market still went up. So that tells you rates alone are not enough to really keep the market from going higher. You got to have the economy also falling apart, and we're not seeing that. So, Paul, the macroeconomics tell us that inflation will continue to decelerate and growth is actually starting to bottom out. So economic growth is starting to bottom out, and that's a good thing. There's a lot of cash on the sideline, a lot of people who are not in stock. So the higher we squeeze, the higher we go, the more FOMO they get. And we're not that far from all-time highs. Like, let's just do the measurement really quick. All-time highs were at 4,800. We're 7% from all-time highs. Okay, we are 7% from all-time highs. So put that into context. 7% was from here. Well, actually, yeah, where we're at right now. 7% from here is where we're at now. Would have been back when the S&P was at 4,000, pretty much. A little higher than 4,000, right? So what that means is, and actually, let me go to, yeah, we are on SPX. What that means is basically this move right here was 7% ago, right? This was 7%. Now we're here. So we just made a small flush to the upside because the fundamentals started to improve. Oh, come on, man. What am I doing? Here we go. So we made an upside move because the fundamentals, started to improve. We squeezed above the 4,200 level, and then we squeezed above that, and then we retested another level. We got higher. So it just takes one more wave to FOMO to get to all-time highs. It's not that far away, right? It's not that far away. From 4,000 to where we're at was 8%, right? From 4,000 to 4,400 was 8%. So from here to all-time highs, 8%, same thing. It just takes one more wave. What's going to accelerate that wave? What pushed us higher? AI, right? Artificial intelligence, better inflation expectations, and the economy starting to recover, and the debt ceiling being resolved. That risk is off the table. So you need more risk to come in. And so the risks are dissipating. And if they hike one more time, I think the market can still make it there. If they hike another time, yes, that definitely doesn't mean we're going higher. If they hike a second time after this, they would be putting us to what? 25 basis points. So we'd go to 5.5, then we'd go 5 2/4, 5 3/4 we'd be at. And the closer we get to 5 3/4, the closer you get to the Fed pumping liquidity back into the market, because the economy will eventually slow. So maybe you're right, Paul. Maybe we don't go to all-time highs in the Qs. I'm sorry, in the S&P if 2 more rate hikes come online. But you know, for the most part, I don't really see not me, but if they do hike 2 more times, there's still a possibility with the economy expanding that the market just keeps going higher because earnings are going to go up. So you have 2 more rate hikes, right? Putting pressure on the market, but earnings expectations go up, right? Because the economy is strong. They're not hiking because the economy is weak. They're hiking because the economy is strong and possibly inflation sticks around a little more. They haven't even hiked yet, by the way. They're on pause right now. So as long as the economy expands, the S&P goes to all-time highs, in my view, as long as the economy keeps expanding and inflation makes progress. Now, I'll say this, Paul, if inflation does tick up, then yeah, we're not making it there. We got to get inflation down. If it ticks up in a meaningful way, I don't think we're going to get there, because that would also fall in line with more rate hikes too. If inflation ticks up, then we're in trouble. So I think it's going to be the actual rate hikes. Earnings quality has been the worst it's ever been. The top 15 companies in the, let me put that up there. And I love the feedback. This is good. Earnings quality has been the worst it's ever been. The top 15 companies in the S&P is carrying the market. The rest of the S&P are flat or down. Okay. Let me see. Not saying it can't happen, but AI hype is pushing us higher, not company fundamentals. Okay, cool. So first off, earnings quality has been the worst it's ever been. One thing you got to realize, Paul, is that the market bottoms 6 to 12 months before earnings bottom. Okay. On average, the market, and I wrote this a long time ago in a post, the market bottoms 6 to 12 months before earnings actually bottom. Right. So what that means is as we get a bottom in earnings, and by the way, the last earnings report, I have it in a post somewhere. Actually, I'm going to pull it up. Let's pull this up. Let me see if I could find it really quick. And what I'm basically going to get at here is that earnings revisions have went up, right? We were expected to be negative 6% on earnings, and we actually came in at negative 2%, I believe. As a matter of fact, I think it's on what is it? FactSet. There we go. FactSet. We'll find out on FactSet. FactSet has all the earnings stuff. FactSet. All right, so let's go scroll down. Hopefully it's down here. Maybe it went up a lot, but let me see. What is this? Earnings growth, S&P earnings growth. Oh, I definitely have it on my profile. All right, I want to make sure we get through this. I want to answer his question. But yeah, earnings typically bottom before the market bottoms before earnings actually bottom. This thing is taking forever. And EPS estimates were negative 6%. So I'll just go with this. Oh, look at that. We're starting to bottom there. So EPS estimates, earnings estimates were negative 6%. And the last earnings, Q1 earnings came in at, I think, negative 2%. So we're beating expectations, which signals that earnings are starting to bottom. We're still expected to be in an earnings recession. Of course, we're still expected to be in an earnings recession, given the base effects. But if we're beating the expectation, then the momentum is picking up. We're going to the upside, right? The momentum is picking up. Oh, I didn't move. Okay, sorry. Then the momentum is picking up to the upside. Man, I got a lot of stuff on here. Japan, blah, blah, blah. I have it on my Twitter, though, down here. Almost there. Here's one. Okay, so this is one. This is one here. So here we go. And let me remove this so we can see, because I hear what you're saying there. Let's just talk about earnings. Let's remove this comment. Remove this banner so we can see this. All right, so S&P 500 earnings for Q1 2023, right? The expectation was negative 6.7%. We came in at negative 2.1%. So we're beating expectations. Okay, that's for just earnings growth. Okay, if we look at revenue, and I know I have revenue on here somewhere. Where's the revenue growth? Expectations there. That's at one. Expectations negative 6.7. Reality negative 2.2. Where's the revenue growth at? Here's revenue growth. No, this is not. That's earnings growth. Where's revenue growth? I know I have it on here somewhere. S&P 500 companies beating revenue estimates. Here's revenue estimates. Okay, so revenue estimates, we have beat 76% of companies in Q1 beat revenue estimates. And then 78% of companies beat EPS estimates. Oh, 76, sorry. And then 78 beat revenue. The point being here that I'm making is that we're beating expectations. So if we were in line with expectations or lower, then I would expect earnings to go down or to keep decelerating. So even if we're in negative territory, it's not negative. What's negative is if the expectations are getting beat or not. And right now we're beating expectations. We're not, we're not falling to the downside. So growth is better. Why is that? And I really want to answer this guy's question or his comment to not answer his comment, but to get to his comment. And the reason why, and here's this chart. Where's that chart at? I have it on here. The chart is the earnings. Equities typically bottom 6 to 9 months before earnings reach their low in the past bear markets. Okay. So this is when you look at all the bear markets and all the way back to the 1950s, it's stocks can keep climbing regardless of earnings decline. So we're right here in this earnings decline. Okay, we're declining. And the question is, where do we bottom? Well, if the EPS estimates and the earnings estimates are getting beat, that suggests that the earnings are starting to bottom out. So either way, stocks can just keep climbing. Now, by the time we actually bottom, which might be Q2, because the expectation is that we're negative in Q1, negative in Q2, and then partially negative in Q3, and then we're back in positive territory in Q4, right? And if that's the expectation, this is where all the bottoming happens right here. This is just an average. This is just a model, right? It's not like a promise or it's not like a guarantee or anything. But point being is that markets are going to bounce. They're going to move higher based on, okay, we saw the worst coming. We saw the worst coming. And so the worst is in the bag. Now, what AI does is it increases the revenues and the growth for those companies, right? They can cost cut. So that's the other part of it. Is when you're getting AI come into the market, what you're seeing is all these tech companies like Meta, right? Look at Meta from the bottom, right? Look at that. That is insane. Why do we bounce so hard, right? It's 234%. The reason these companies bounce so hard, and because I know you mentioned like there's only a couple stocks that are moving the market to the upside. They're carrying to the upside. Well, they're moving up because their earnings estimates are going up. Their margins are increasing based on the fact that they're able to cut their labor force and still grow their earnings, right? So that's very positive for these companies, right? Not for all companies, but it's very, very positive for them. So if they're able to do that, then you're going to revive. Now, who carries most of the earnings in the S&P 500? You said there's top 15 companies in the S&P carry the market. Well, if their earnings are carrying the market, that means S&P estimates are going to be higher. Does that make sense? If S&P estimates are higher, and earnings are growing in the S&P based on these 15 companies, why shouldn't they lead? Shouldn't they be leading the market out of the bear market? That's how I look at it. Is if the leaders should be the ones that are literally making better revenue. Those should be the leaders, and that's exactly what we're seeing. It's not negative. Okay, you want to go to equal weight? Well, equal weight's not collapsing. So you're talking about market breadth here when you say there's only a couple companies. This is the S&P equal weight. So you're taking away, right, the mega caps from carrying the index. Well, equal weight isn't in negative territory. As a matter of fact, equal weight is up 18% from the lows, and it's only from the highs. It's down 10% from the highs. So yeah, equal weight is not moving higher, but it's not collapsing. So it's not falling over. If it was rolling over, that'd be a different story. If we go to the IWM, right, IWM is still low. So we need this to break out to really confirm the bull market. Either way, the S&P, because those big tech companies are such a big piece of the S&P, they're going to carry the S&P higher, right? There's no arguing with that. The Qs are almost at all-time highs. Like they're pretty close to all-time highs already. And so the real argument here is, who cares? Who cares if the top 15 companies are moving the market? That doesn't mean we're going into a bear market. As a matter of fact, usually when companies start to roll over, then that's a signal that the overall market's going to roll over also, right? Once you get them rolled to the downside, that's a confirmation that the market's that's kind of confusing to think about. Either way, AI is not hype at all. They've been using AI. It's helping their margins go up. It's helping revenue. It's helping growth. And overall, that pours into the S&P and it pours into the Qs. And, it's just another regime. It's just a strong rally, or the rallies coming from the strength of the strongest, right? They're leading the army, the best bazookas, the best weapons, the best warriors. Is, you know, if you want to compare it to like recovering as an economy or in times of war, the strongest soldiers are leading the charge, of course, right? I don't see an issue with that, especially when they're bringing revenues, real-time revenues to the stock market. And there is a lot of AI hype. So if we do go to AI, like the company called AI, this is hype, right? This is AI hype. This isn't real AI. So this isn't leading the market, though. The market is not getting its signals from AI, right? It's not getting it. It's getting its signals from Apple, Amazon, Google, Facebook, and Apple is three. Here's another thing. Apple's $3 trillion. You know, Apple's also is actually bigger than the small cap index. Apple alone is bigger than the small cap index. So it's, if as long as Apple goes higher, the stock market's going to go higher, right? You don't need market breadth for the market to go higher. Just typically people need market breadth to confirm or deny whether a bull market is back in play. So I get that part. Are we really in a bull market? Well, I mean, we are in the tech. We are in technology. We're definitely in a bull market in technology. The Dow, it's kind of sideways. Small caps, not really. Small caps are not there yet, but we do get a lot of flows coming into small caps. They just need to hold the line. They definitely need to hold up here. So I know that was a long-winded answer, but I definitely want to express my concern or my thought process going into that. So yes, we need small caps to move up, but this ain't going to happen until really rates come down. So we need rates to move lower. So typically what'll happen is, what we'll see is the S&P keeps going up, the Qs keep going up, IWM is still stuck, the Dow is still stuck. And then when rates actually fall, IWM goes up, and then the S&P makes new highs, and then the Qs make new highs. So really, do you just say, okay, well, because the small caps are not moving up, this is not a bull market, right? If you're an individual stock picker, that would be a bad way to invest, because you would say, oh, well, I'm not buying Tesla, right? Even though they're innovating, they're coming out with full self-driving, their revenue is better than any auto company. Their margins are got cut, but their market share is improving. Everybody is using their supercharger network, but IWM small caps are still in a bear market, so I'm not buying Tesla, right? So my point being is, it doesn't really matter if small caps are not in a bull market yet. It doesn't really matter. It's all about inflation. At the end of the day, it all comes down to inflation, and the Fed is data dependent at this point. So we'll see how that plays out. I mean, shoot, if inflation goes up, we're in trouble for sure. That's my view on that. See what else we got down the pipeline. Tesla SPY trying to move. Yeah, so back to the actual, get back to the screen. See what we're looking at here. Oops, let me switch this up. There we go. Yep, we're now above VWAP. So far, that's been the case. We're above VWAP. We broke the downtrend. S&P is now, starting to turn up again. Advanced decline is turning up sharply. See what they're saying here on CNBC. Make sure this volume is down so I can check really quick. Oh, we got some Josh Brown here. Can listen to a little bit of Josh Brown, see what he has to say. Tesla's moving back up. You also have crypto. Crypto is also another market breadth indicator. Crypto's up 100%, right? 100% from the lows. And the German DAX is up at all-time highs. The Japanese Nikkei all-time highs. So it is kind of misleading to point out what is it? And I'm not just trying to pick on you, Paul. I'm just pointing some things out. 15 companies leading the S&P. That's not bad unless the rest of the stock market is rolling over. Because what it means is, well, something has to lead, right? Not the whole market doesn't lead in unison. Something has to lead, and then you get a next leg higher and the other stuff. Well, I'd argue globally that the global stock markets are actually leading our stock market, right? German DAX, Japanese Nikkei, I believe the Brazilian or the Mexican stock market is up at all-time highs. They're not that big, but global breadth is picking up, right? Because China is stimulating, and inflation is falling in a lot of countries. And it's Europe who's struggling with inflation. European inflation is still pretty high, but for the U.S., I mean, we're down from 9%. We're down 9% down to 4%, and I think we're going to see the threes next print. Yeah. Also, I wouldn't even say it's 15 stocks. Like, let's look at, like, that's not even true. Because I'm trying to think this through. Look at Caterpillar. Right? Caterpillar is not part of those 15 stocks. Caterpillar is up at all-time highs. Right? Caterpillar is up at all-time highs. So that's not part of the FANG, but it's up at all-time highs. So that is market breadth. Okay, how about Deere? Deere near all-time highs, right? Higher than the FANG. That's not part of the FANG, but it's at all-time highs. How about McDonald's? McDonald's all-time highs, right? You have market breadth. McDonald's all-time highs. Who else is at all-time highs? Visa nearing all-time highs. A lot of stocks are still moving higher. It is not just Apple, Amazon, Google, Facebook, Tesla, and the Tesla's not even up near all-time highs yet. Google. So like, I don't even think that's even true. I don't even think it's actually accurate to say only 15 stocks are moving the market when and the reason I keep going at this is because I'm trying to think, am I wrong here, right? Am I wrong? What is it that I'm seeing in my head that doesn't prove that? If I do go to 52-week highs, let's go to 52-week highs. We could probably see who else is leading the market. Mega cap. No, not mega caps. Any cap. Mid to mega caps. That'll be better. Monthly charts. Yeah, we do have a lot of companies. Large caps. Who's this? Freeport McNamara. They're up there. Wells Fargo. JP Morgan. What does JP Morgan look like? JP Morgan might be up there too. I wish I had the data. How about above the 200 moving average? That's probably a good way to look at it. Price 100% above. Oh, okay. 5% above. Price at least. Price above 200 moving average. There we go. And the 50 has to be above. Price above 50 moving average. Lee Auto, Love, Snow. Oh yeah, Snow's getting crushed. Airbnb. Oh, I know Chipotle is another one for sure. Chipotle is another one. So looking on that chart, what is Chipotle's ticker? I think it's, oh, that's CME Group. Dang, what is the Chipotle ticker? I cannot think of it. Anybody know? Oh, what up, Amit? Generally speaking, if you remove the Apple, Microsoft, Google, Amazon, Nvidia, the market will only be up about 2 to 3%. Yeah, and I think that's okay. Maybe it's up. There's a lot of there's a lot of companies who are near all-time highs. It's not just it's definitely not just Apple, Amazon, Google, Facebook. And what I'm saying is here, yeah, you can remove them, but they're a big piece of revenue, right? So if they're driving the S&P, if the last 10 years have been driven by the biggest companies, why would you remove them to get a gauge on where the market's at, right? You can get a gauge on the rest of the market for sure. And I'm telling you, McDonald's, a lot of these companies are still at all-time highs or nearing all-time highs. Monster, I think it's Monster. Look at Monster. Monster's at all-time highs too. So they're moving the market, right? That is market breadth. Chipotle, CMG, yeah. Chipotle had a big move. CMG, I got some Chipotle all-time high. There you go. Chipotle all-time highs, right? So there's a bunch of companies, like I can't think of all of them, but I know there's a lot of companies nearing all-time highs. They're higher than the actual thing. And so you're saying, generally speaking, if you remove the Apple, Microsoft, Google, Amazon, Nvidia, the market will only be up 2 to 3%. And it does depend what you're looking at too, right? It depends what you're looking at. Are you only focused on the Qs? Are you only focused on SPY? Because how do you measure market breadth also? Is market breadth just the S&P 500? Is it you're taking a big piece out of the S&P 500? Because if you take those out, well, what are you replacing them with, right? If you replace it with Chipotle and Deere, then the S&P is still back up because they're at all-time highs. So I just think, Paul, I don't really think that is I don't think it really holds weight. I don't think it holds weight. I think a lot of people try to use that argument that if you take out the Apple, Amazon, the FANG, right? If you take out the FANG, the market it won't be up as much. Don't get me wrong, it won't be up as much. But if that's what the economy is, if you're using Twitter every day, if you're using Apple's, every day, if you're using Microsoft every day, if you're using Google every day, if you're using Amazon every day, if you're using all these products every single day, and you remove them from the S&P, it's not really a reflection of what's actually happening in the real world, right? Because everybody watches Netflix, everybody's on Twitter, everybody wants a Tesla, everybody's using Meta and social media. Not everybody, not literally everybody. I'm being a little exaggerative, but it doesn't make sense to remove them and say the market wouldn't be up without them. It's almost like saying, well, I'm the fastest guy in the world, but if you took off his toe, he wouldn't be well, duh. You know what I'm saying? Does that make sense? It's just, that is the market. That is the market. And it's only going to continue, right? Then the reason is because they're part of technology. They're literally creating productivity in a world where demographics are falling, where we have to print more debt, where GDP is really non-existent without technology. So plus two, Paul, I know I'm kind of like, staying on this, but Paul, in general, we're coming from a bear market. So I would say this, you would be completely right if the S&P was at all-time highs and just trending up, and all the rest of the stocks started to fall off a cliff and only the FANG is up, then that would be bearish. That would be bearish. But coming from the lows, $5.5 trillion in cash, when you look at $5.5 trillion in cash, when you look at the consumers, you heard earlier, a lot of these fund managers are still underweight stocks, right? 401ks are still buying consistently. Inflation in the macro is turning up. We're not in a recession. So coming from the lows, it really doesn't matter. It matters more that that's a bearish signal when markets have been at the highs and are getting overextended. When we just got a big short squeeze, right? Record positioning in the S&P 500. We're just a big record negative positioning was at a 15, 20-year high for S&P. They got squeezed, right? That was that big move to the upside. They got squeezed. And so, yeah, I don't think alone that just holds any weight. And I can go all day about this because I've been, I have a lot of, I do newsletter every single week on the macro. If you want to check it out, this is not personal. Please don't take my passion for talking about the markets ever personal. It's just how I talk. Anyways, what up, Amit? Is that really you, or is that a bot, or is that real Amit? Shout out to Amit. He got all the Palantir. He's in the chat right now. This is Amit. He got all the Palantir. That guy knows everything about Palantir. He's probably one of the best speakers I've ever heard, and he's really good at the research. He has a podcast weekly, so shout out to that guy. Amit, solid dude. We got to do an interview again, Amit. Looking at the macro. Last time we talked, I told you, hey, I think the macro is pointing at this bull market breaking out. I think Palantir can go a lot higher, and that's what we've seen, right? They finally beat expectations. All those negative expectations they've actually beat. So yeah, AI basically the reason why these big tech stocks are going to move the market is because they can produce 10x, 10x. They can create productivity at 10 at the 10th of a cost using AI. At a 10th of a cost, you're 10xing your productivity. And that's the only way to actually grow GDP. That is the only way to grow GDP. Anyways, yeah, we'll take a look down here. What else do we got here? Tesla SPY trying to move. Yeah, S&P is moving for sure. Let's zone into the S&P. I love the bear arguments. I love this can't be a bull market. I just love it. I love it because oh, look at that. Look at that bounce. What do we say? That we're probably going to see a big bounce because there's not really anything too negative. There isn't really anything too negative going on. It's mostly rates are higher. Let's look at TNX here. What are we seeing for TNX? Why isn't this popping up? Come on, man. TNX. I think might have been too much juice on here. Bugging out on me. Always having computer. Maybe the market is just too strong. We can't even pull up the data. Pulls up Tesla though. That's weird. All right, so we are getting that recovery. We'll do a quick listen in on Josh Brown and what he has to say, and I'll respond to those comments. We'll respond to those comments. Quick little break, so we can keep this rolling. It is Thursday. We have the jobs report tomorrow. If you're just jumping on, we've been talking macro, the bullish setup, right? This pullback is just a quick pullback, but it is a very bullish setup. And we are going through the market commentators and giving our comments on what they're actually saying. Does it actually make sense, right? Does it actually make sense? Anyways, I'll be right back and we'll go over this. Let's get that dance music on. Or the break music. I gotta get this better. All right, we'll be right back. Market is bouncing. Let's go. All right, we are back. We are back, and we will keep this up. Market is finally starting to bounce here in the left-hand corner. It's not over yet, but I just think these dips get bought, right? I really think these dips get bought up, and I want to thank Paul for throwing out the commentary. Thanks, Paul. Really good commentary there. I mean, some good pushback. I want that pushback, guys. Like, if you're on here, you don't agree with me, push back on it. I'm not trying to make you look dumb, but I do want you to factor in all the actual factor in all the variables before you hold your thesis, because a lot of people they'll just look at one thing. There's so many things happening in the market, and they'll look at one or two things and be like, oh, I'm bullish, or oh, I'm bearish, right? So there's a lot of factors to consider. Once you consider all of them, then you sort of say, okay, where do I stand? You know, make your decision from there, but at least have all the data on hand before you actually do that. So yeah, we'll get to this Josh Brown video. Listen up to what he has to say, and we'll react to it.
That was your peak. Now you're back there today, hit in March. Look, you're at a 2-year treasury now at
there. Also, the regional banks hard hit right now. Something we're going to continue to watch and talk a lot about. Regional banks down more than 2.5%. I think that's a really great place to start. Josh Brown, I'm going to toss things out to you out there at the Josh Cave. What do you make of the sell-off that we're seeing so far? Obviously, rates the big story.
Look, you're at a 2-year treasury now at 5.06%. That was the peak, which we hit in March. Ever since that faded, and obviously that fading coincided with the banking crisis, that was your peak. Now you're back there today, but with a very different backdrop than we had in March. The recession calls all over Wall Street in January, February, March were fresh in all of our heads. So when you saw yields fading, when you saw bonds rally, it made a lot of sense, because you said to yourself, all right, we've probably already seen the peak for this cycle, and it's only a matter of time now before the economy gets bad enough that the Fed is going to have to start contemplating cuts. And in fact, there were a lot of expectations back in March for cuts in the second half of this year. Today is a very different picture. Today, we're seeing yields rise, and you know, this idea that there's going to be a cut at some point in the second half of this year is non-existent in the data. So I think it partially explains why we've seen the leadership that we've seen in industrials. People look at PMIs month after month. The manufacturing part of the economy is slowing, and yet these stocks are defying gravity. And if you were looking at both of those things, you would say, this is wholly incongruous. It makes no sense. Why are industrials the leading sector this year, ex-tech, when you've just got terrible data coming in? And this is the reason why, which is that there is a growing sense that so long as the employment picture remains strong, and so long as the consumer continues to consume, by the way, half the jobs added in this ADP survey were leisure and hospitality, which is the consumer writ large, then maybe it's possible the manufacturing slump doesn't spiral down into a full-blown recession. And at some point, we see the data in those surveys, those components of the economic picture start to improve. So it's maybe premature to say that that is what's going to happen, but you're starting to hear more and more people think that the manufacturing part of the economy is going to catch up to the consumer-driven part, rather than the consumer-driven part catch down to what we've seen in that space. So we'll see.
And why is that, right? Yes, the services are still strong. Leisure and hospitality had the most gains, right, when it comes to these jobs. And what he's saying is it the consumer that's going to roll over to match manufacturing, or is manufacturing going to pick up goods, right, versus services pick up to match the consumer, right, in services? I think what you got to really factor in here is that even though the Fed is tight, we're not in QT. We are not in quantitative tightening, okay? Joe Biden is the White House in general, right? The Biden administration. They've done a lot of fiscal policy, the infrastructure bill, the CHIPS Act, the Inflation Reduction Act. They're still building stuff. I'm seeing it here in Phoenix, the Taiwan manufacturing facilities. There's a lot of building happening. So even though manufacturing as a whole is falling apart or is still decelerating, how close is it from the bottom when China is printing, when Japan is printing, when the global economy is starting to recover, right? How close are we from seeing the manufacturing sector actually start to bottom in those PMIs, right? I think we're pretty close. I think we're pretty close, because all this onshoring away from China, we're trying to onshore stuff. So whatever it is that we need to build, we don't want to build it in China. We're building it in the U.S. So eventually that's going to reflect in the U.S. And I'm seeing it around here. I'm in Phoenix. I know there's other areas where they're not really building, but they're building at such a quick rate. So I agree with, well, I don't want to say I agree with Josh here. He's just throwing it out there. And I'm saying, yeah, I think the PMIs are going to bottom by the end of the summer. What do we got? July, August. I'm going to say by July, August, September. I'm going to say by August or July, we see the PMIs tick back up. We're at 46 right now. Okay. We're at 46. We need to cross above 50 for the manufacturing sector to actually recover. And that's going to be another bullish signal, because if we get above 60, if we get above 50, we are now expanding in the services sector and the manufacturing sector. And maybe, rates go higher. So I still think it comes down to inflation. But if we're starting to expand, right, then and the Fed keeps rates higher to keep inflation down, that's a good thing, because you're getting the economy expand. And if you keep rates high, you can't borrow as much. So it's real growth coming from fiscal policy. People have jobs, they keep spending, but nobody could really borrow, which really causes inflation to go higher, is very low interest rates and a lot of borrowing without demand. Now, if you get supply back online, right, as people build, as more services come online, as more people into the workforce, you can allow for demand to rise, because now the supply takes care of the demand. The supply eats up. The more supply you have, the less price pressures you have on the demand side. So eventually, really, I think the answer to getting inflation lower is actually more productivity. It's not kill demand. It's actually produce more, create more productivity, more supply to get those price pressures down. And that's might be what we're starting to see play out here.
See what happens, but that seems to be the sentiment today.
Yeah, I mean, certainly, Josh, I think you hit on a couple crucial points. Amy, I'm going to come over to you. Not only is there no sign of cuts, I think they've been pretty much taken off the table based on those minutes yesterday. And as a matter of fact, the majority of the FOMC actually favoring 2 hikes.
Right. So the cuts are out till at least the end of 2024, based on expectations. So I think Josh is right. I mean, we're seeing a rise in rates. In my opinion, that makes equities less attractive. 2-year real rates are higher than they've been since the global financial crisis. So I do think that has to reverberate back to the equity market, which we're seeing somewhat today, but we haven't really seen it all. I do think more and more investors are pricing in a soft landing. I don't think that's going to end up being right, but you're seeing it. The Citi Economic Surprise Index turned negative for the first time in June. That means people are getting, their expectations are more optimistic than they have been. So the more and more you get this soft landing priced in, you are going to see these rate hikes go up. And you're sort of seeing the markets trying to defy gravity, but at some point they'll probably be brought down.
So, Sarat, are you seeing the same optimism?
It's really tough for people to stay optimistic. You see, they say, okay, well, things are getting better, less chance of recession, labor market's up. But, I think we see everybody's, if you're not bullish, if you're not bullish, you're bearish. If you're not bearish, you're bullish, right? It's so mixed up, which means people are bullish in the short term because the data comes out better, but then they're like, well, we're gonna have this rollover effect. What's a real correction? Is a correction 3%? Great. That's not a real correction. Anything more than 10% is going to be a real correction. What I'm pointing at here is that the market's going to pull back. You can't just say I'm bearish on the market. It keeps going up. It's up 10% and it pushes back. It corrects 3%. You're like, I told you. And it goes higher. Okay, great. It pulled back 3%. We need new lows, right? You need to be downtrending for us to really turn back into a bear market. So a lot of these analysts, they just can't believe how resilient the market's been. This is coming from a lot of the policy and a lot of the fact that technology really, and that's why the FANG is leading, technology just solves a lot of the inflation issues and still produces more growth. And so they keep saying, well, we're gonna grind up and then we're gonna get, we're gonna hit the top and then we're gonna come right back down. That's not how it works. If we got that much momentum, you need a black swan to crush everything back down. The market's gonna keep bidding up because it's looking into 2024. It's looking into earnings growth and the Fed pausing or the Fed cutting rates in 2024. It's gonna keep looking ahead. And unless there's some surprise where it's coming from, I don't know. Unless there's a surprise, we're gonna keep going higher. If there is a surprise, what did we see last time? We saw the Fed step in with the bank term funding program. So if we get a banking surprise, say this all the time. If we get a banking surprise, here comes more liquidity into the markets, right? So either way, we're going to get that. Plus, we're headed into a presidential election where what do presidents do? What do officials do? What do regimes do when they want to get elected? They push out more stimulus in some way or another. They're going to push out more stimulus. So same deal there.
Going to point to the VIX for a
Oh, what up, football legends? Taiwan Semiconductor is building huge sites in Arizona, and part is because of the fear of China invading Taiwan. If the invasion happens, self-destructive systems will evaporate some plants in Taiwan. Yep, yeah, exactly. So that would be a risk to the market for sure if we get that invasion. I really doubt it happens. I doubt it happens at this point. It could happen. I doubt it happens at this point, but for sure that is a risk. What else did you say you got here? Taiwan Semi has been hiring crazy. A lot of hire. Dude, I don't see jobs. I don't see the recession coming. People are gonna have jobs, and okay, if they lost their job, they can switch to another job. If they choose not to, that's on them. That's on them. Oh, I can't do it. We're in America. We're in the best country of all time. Like, there's jobs everywhere. If you lose a job, get another one. You can't have it your way. So what I'm saying here is people will make the exception that, oh, well, not everybody, they didn't like that job. Bro, there's still a job. There's still a job in education and leisure and hospitality. So either way, growth is going nowhere. People are going to spend. I applied for fun and got 5 interviews. Nice. Yeah, that's what I'm talking about. Exactly. Exactly. So the recession is slowly coming off the table. The recession is slowly coming off the table. And the only thing next, oh yeah. What's going on? Yeah, we're just we're going through a bunch of stuff. I'm listening to some of these analysts and seeing what they're saying. How are they reacting? Basically, Asan, what we're seeing is, this big pullback in the market. Oh, I guess you can't see it. I don't have it up here. But this big pullback in the market from the S&P was driven from rates. I think the algos really hit the offer. The algos hit it first. Rates are going up. Bond yields made new highs. But when you look at all the backdrop, there's still a bullish setup, right? The VIX went up a lot, but there's still a bullish setup. Like, it's not really bearish. So it was an overreaction in my view. And I said, hey, we're going to find a bottom. And I think we bounce here. Yes, it's intraday. We still have more data tomorrow, but now we're back above VWAP. So the fact, and you guys can't see the charts, but the fact that we bounced so hard, and if you look in the daily chart, you're going to see a big tail, right, on this daily candle for the S&P and the Qs. You're going to see a big tail. That's a sign of strength. That is a sign that buyers are still here. And that's part of is this the uptrend? Yeah, that's part of the uptrend. So that tail, if we finish at the highs, is a sign of strength. Maybe we roll back over, possibly, but the fact that we got that bounce in the first place, very optimistic that this was a nothing burger, that this was just higher rates. But at the end of the day, if we have higher rates in the bond market and the economy is still strong, it's really up to inflation next week. It's really up to inflation next week, whether these rates can stay elevated.
I mean, it closed at 14 yesterday, above 17 today. We're seeing a pretty big sell-off. Small caps, the Russell hit harder than the other 3 indices. Are you seeing any optimism out there that there can be a continuation of this rally somehow, somewhere?
No, I think, what Josh was hitting on was we need the data to keep on being positive for the consumer. And if we see the consumer pulling back, which we haven't yet, because you've seen travel, leisure, all that really doing well.
Good jobs report. Is that data?
That's a good report, but that puts the Fed in the crosshairs, right, because they have to raise rates. So essentially, I think the way to kind of look at this to say is you have to be very careful as to.
The Fed does not need to raise rates because the labor market is strong. The Fed has to raise rates if inflation moves higher. Not because the part of, like, this guy's bearish. I could already tell. He's bearish on the market because part of their mandate is to keep the labor market strong. All right, it's to keep the labor market strong. The Fed is also not dumb. They understand the more workers in the economy, right, the more participants, yes, they're going to spend more, but the more workers, the more production, the more supply side inflation goes lower. So people tend to forget that. They don't understand productivity. They don't understand the difference between supply and demand side inflation. I'm not saying, oh, I understand all this. I'm just saying in general, you might want to know that more workers, more labor doesn't mean more inflation. In fact, if people are fearful of a recession, they're going to spend less. And if they have a job, they're going to produce more. And we're seeing in the data, the savings rates going up, incomes going up, and spending going down. So people are literally reacting to brace for recession while they're producing more into the economy. That means less. That means less inflation over time. I still think inflation collapses by the end of the summer. Core is going to come down. That shelter is going to finally price in. And it's annoying, but I'm going to keep saying it because when it happens, you know, we're going to get that wave 2 FOMO coming in because everything is about inflation. Maybe it doesn't. Maybe I'm wrong. Maybe we roll over. You know, maybe we roll over. We don't get it. Shelter stays higher than expected. Then we should be seeing the dollar spike. And we should see bond yields make new highs. And that's risk off. But, you know, with with OPEC trying to cut production and oil still can't get above 75, I doubt it. They can't get above 75, so they're struggling because there's not enough demand. Those PMIs are still weak. So really everything's playing out. Everything is playing out in the macro to really for a bullish setup here. We need a surprise to the downside. Maybe there is a surprise, but I'm not seeing it. These guys are coming in and buying the dip. They're coming in and buying the dip. And the moment things change, we will know. I'm on here Monday through Friday, right? Saturday. The moment things roll over, then or something changes in the market, then we'll see that even triple B spreads, right? One of the risk indicators that those are still falling, which means investors are purchasing or they're at least taking risk in corporate bonds, which means they're buying the debt of US equities. They're buying debt equity. That's bullish. That's risk on. If they were ditching the debt equity, they would be buying US treasuries because that's government debt because they pay them. But they're saying, hey, there's more value inside of equity debt than there is in government debt. There's more value there. So that risk is not there. We're not seeing that. So anyways, yeah, I just want to point that out on this dude. He's probably bearish.
What equities you're going to own, because high valuations and high interest rates just don't go together.
Right.
So really, you got to parse through what you own and also understand that there's an opportunity to be in other assets. Fixed income gets a lot better when the 2 years at 5%.
I knew it. I knew it. He hey, there's nothing wrong with having bonds in your portfolio. We're at, you know, all-time like biggest pullback ever in bonds. But if the economy is as strong as it's showing, and it is recovering, what is the point in buying bonds, right? At least for overweight. You could be underweight bonds. I think that's not bad because you're going to get a yield from it. It could balance out your portfolio, but most people are looking for a big return, right? They want to see their, you know, Bitcoin, they bought the bottom of bonds. Okay, bonds double in the next 2 years, 3 years, 4 years, and you get some interest on it. Or you buy Bitcoin and it literally triples, quadruples, 10x's, you know, over the next 2 to 3 years. Tesla does a 5x over the next 2 to 3 years. Maybe not from here, but point being, you're getting a better return in stocks. And this guy is talking about the Fed hiking rates and now going bullish on bonds. He got really excited talking about fixed income. And fixed income's cool, but guess what? Rates are just too elevated. They don't build enough alpha. They don't have a lot of alpha when it comes to there's just not enough alpha. That's why the bond market is selling off right now. The rates are going higher in the bond market because primarily the economy is stronger. So if the economy is stronger and it continues, then people are not going to hold bonds because what's the point to hold bonds when growth is accelerating and cyclicals and companies are, you know, the earnings growth is going up. You want to own stocks. So we'll see what he says.
Hold bonds for 3 to 5 years, getting a 6 handle on it, which will give you a lot more downside, especially if you're closer to a certain age of retirement or your objectives are changing.
You know, it was interesting earlier this year, we saw bond yields spike, but equities also rallied as well. So it's very interesting. Joe Terranova, I'm going to come over to you. Sarat mentioned something.
Yeah, what is that? What did he just say? We saw bond yield spike. We saw bond yield spike, and we saw equities also rally. Why? Because the spike in bond yields was a reflection of people selling their bonds and buying stocks. Because this is, you know, the growth prospects are better than expected. So there's that rotation happening, and you got to pay attention to the rotation. Right now, we're not seeing that, but we are now, right? In the morning, bonds spiked. Yield spiked, and the stock market sold off, and the dollar went higher. So they sold their treasuries into dollars. And now that we're getting this bounce in the S&P, look at the S&P from the lows is now up 0.5%, which is, basically from 437 to 439. I'm not saying it continues. It could roll over by the end of the stream, but they're going right back into equities because they're reevaluating and saying, hey, what's actually happening here? Why is the bonds yield spiking? Is as bad as it negative? And now that the market is digesting it, and I said that the market needs to digest this news, from what we're looking at, the only risk is KRE rolling over, because then the Fed would have to step back in. But that's still bullish because they're printing more money. And so at that, look at advanced declines spiking up. We're getting a nice recovery here. So still yields go up. People are selling their bonds. They're rotating into dollars, and then they're rotating back into the market. Tesla's back up. And this is just intermediate. I know this is short term. I'm just trying to get you to process the fact that money moves around. So where is it rotating into, right? Where is it rotating in? Where is it not rotating into? It's not rotating into all stocks either. Some stocks are too risky with rates this high. They're too risky. They're not going to catch a bid. When I look over here to the left, IWM, it's up there, but IWM is not going to be as strong with bond yields this high, because there's a lot of interest rate sensitive individual names or individual companies inside of the small caps, and they're not all profitable. So it's a little more risky. Where Qs, the Qs have the big mega caps. They're going to go higher. So I expect the Qs to continue to rally with rates elevated versus everybody else. If rates come down, let's say bond yields come down, they start to roll over. Well, we should see IWM really catch a bid and riskier assets catch a bid, because that future expectation of cash flows now is, the borrowing becomes cheaper. All right, we'll finish up here.
Something valuation. We talked about it when you were here yesterday. We're seeing rates rise again. Does that also kind of construct your opinion on the valuation of some of these mega cap tech names that we've seen run up?
It's interesting, Frank, because when I think about mega caps and technology and growth strategy, that's exactly where I want to be if markets are going to correct further. I don't see anything in the composition of the way the market is trading today that would suggest you want to change that strategy. It's not as if you're seeing value or the equal weighted index make a return where it's outperforming. No, it's struggling once again relative to technology growth and mega cap. So if you've missed the chip trade, if you missed the generative AI trade, if you've missed returning to growth once again, what's going on right now with yields acting as a catalyst to impede the progress of the equity rally that we've seen so far year to date and potentially initiate some form of a correction, it's actually a welcome opportunity for those that have missed the first half of the year, that trade. And I think that's the way you have to think about it. Collectively overall, you cannot expect to see a rise in a 2-year yield of nearly 140 basis points over the course of 60 days and not expect that to impact equities overall. It's going to. I think it's something that the Federal Reserve needs to give consideration towards, because it is going to further stress the balance sheets of regional banks. That's unquestioned, and it's going to.
What did we just say? What did we just say? See, I know exactly what I'm talking about. No, I'm just kidding. That's stupid. I'm just playing. What I'm saying, but basically what I'm getting at is we're on the same page here. That's going to stress out the regional banks. Okay. That's going to stress out the regional banks. And the reason I am interpreting these guys, because they say a bunch of words, but let's just keep it simple. That's going to stress out the regional banks. And he said it really just creates a buying opportunity for equities, which Asan, Football Legends, just pointed out. The sell-off is an opportunity to buy those who got left behind, like fund managers that were bears for a long time, and they missed this rally. Yeah, exactly. Rates go up, they get nervous, everybody gets nervous, they sell off, the algos hit, and the people who are not in the market rally yet, they're saying, oh, this is a buy the dip opportunity. And what do we see? The S&P bounce right back to the opening highs. This is a recovery. Why? Because there's no real risks here. The real risk for the big indexes, the strong balance sheet companies, are okay. The real risk is in the small caps. The real risk is in KRE, the banking sector, who can't handle higher rates. But at the end of the day, it's still bullish for the market because, like I said, I'm punching it in and nailing it into your mind. If the KRE, if the regional banks roll over again, if the regional banks fall apart again, that just means the Fed comes in with more liquidity, bank term funding program, and the capital markets bid higher. It doesn't go into the economy. It's not inflationary. It just goes into the banking sector and it creates more certainty. That certainty the market loves. Uncertainty is what the market is worried about. So yeah, exactly, Hassan, 100%. At some point they need to switch. I'll put that at some point they need to switch and start to buy others, or they'll get fired. Exactly, 100%. If these fund managers don't, they're going to get fired if they don't recognize, like, hey, if they keep saying, oh, AI is overbought, it's not overbought. AI is just getting started. It's just getting started. And I don't think they think it's some fad, but artificial intelligence is 10xing. We've never seen this. This has never happened before in an economy where you get 10x of productivity at a tenth of a cost. Don't quote me like that's a fact for every single AI application. That's not what I'm saying. What I'm saying is the potential solves the GDP debt problem in America, really in the world. The potential of AI solves the GDP problem. And that's huge because governments can now not worry about it. It removes a lot of the financial risks because your debt isn't growing anymore, right? Your debt doesn't have to grow. You don't have to grow your debt to actually produce GDP. You can actually create more productivity. So that's a very important factor there on the macroeconomics and history, is that the GDP problem is really the big problem here. And if AI solves that over time, going literally in every single area of every company, if AI is solving that, making things faster, stronger, smarter, better, then trust me, governments are going to spend in AI, which is what China's doing. That's what the NVIDIA explosion is about. Getting chips up, going after more chips. Invading Taiwan is about really creating a more robust technological how do I say this? Man, I'm sorry, I lost for words here. But the whole going after NVIDIA, or I'm sorry, the whole China Taiwan thing is literally a signal that AI is that important, that they need the chips to really build a strong technical economy, to increase their technology. Really, a lot of is generative AI, so that they can be a powerhouse, right? So they can stick around. If you fall behind, you're done. As a nation, if you fall behind, you're done. You're going to a second or third world country. You got to sprint to stay in place. You can't just be okay with it. You're going to fall behind without AI. So that's why it'll continue. We're not even in the bubble yet. It'll continue to bid up. Keep that in mind. AI is much bigger than most people understand. If you're not a software engineer, if you don't work in AI, you don't get it. I don't get it. I have to do a lot of research to understand this. Again, go check out Amit's channel. He talks about AI every day. Anyways, we'll get back to the commercial break. We'll get back to the back to what this guy is saying.
To continue to constrict lending and lending standards, and that is going to be problematic as we move in the second half of the year. So it's growth, it's technology, it's mega caps.
Yeah, KRE down 2.5%. I want to pull on the thread of what you were just saying before. I'm looking at the SMH, the chip ETF, the WCLD, the cloud computing ETF. Are you saying this is a buying opportunity right now? Are you concerned that tomorrow they can move another leg lower if we see a jobs report that's either in line or hotter than expected?
Frank, I'm not going to make a prediction on whether you should be buying in the next 24 hours. What I'm suggesting is these are the areas of the market in which you've had strength so far year to date. And history generally suggests that when you reach the midway point, the areas of the market where you've seen the strength, they tend to maintain that strength through the remainder of the year. So a lot of people have missed the chip trade. They've missed the mega cap trade. They've missed the technology trade. And if you get a further correction with rising yields as the catalyst, those are the areas of the markets that I want to add.
Exactly what you were saying, football legends. Exactly what you were saying. See, we're right on the same page with these guys. Just because they're on CNBC doesn't mean they're bad or they're negative. They all have different opinions. It's such a false narrative that, oh my God, CNBC is trying to front. That is the dumbest low IQ thing I ever heard. Most of them don't even agree with each other. They might be bearish for different reasons. They might be bullish for different reasons. They're always disagreeing. It is a dumb false narrative to think CNBC is so negative, or they're just trying to front run your money. What are you talking about? That makes zero sense. There's literally bears. Like, that's just the dumbest thing I ever heard. I just want to point that out. These guys disagree with each other all the time. They have different reasons, and you're just really trying to get the best information and decide for yourself. So now we're both on the same page here. The 2-year yield going up, crushing, creating a buying opportunity for those people who are who just didn't get in on tech. That's happening. And you saw it too. AI is gonna going the same role as atomic power, atomic bomb played after World War II. That's funny. Did you read my post? I literally wrote a post about that, Hassan. I mean, I'm not there yet. I didn't finish it, but it's basically that yes, AI is a nuclear weapon, right? We haven't seen war. We haven't seen a war. Trust me, the downside of AI is coming. The downside is coming, and the downside is deep fakes first. Deep fakes tricking a lot of people, causing a lot of unrest politically. It is a nuclear bomb to the upside and to the downside. It can save your economy and it can destroy your civilization if you use it wrong or if you don't have constraints on it. That's why we have Palantir. But yeah, it's like an atomic bomb. Whoever catches this technology first is going to be the superpower, 100%. No, I was just playing Hassan. I know you didn't. I was just saying basically, yeah, hey, we're on the same page here. We end up being on the same page. And this guy is right, though. Joe Terranova, it's a buying opportunity for those fund managers who just got left behind in tech.
To positioning.
All right. Want to switch gears a bit. Let's bring in senior economics reporter Steve Leisman. Steve, some Fed speak today, some very hawkish Fed speak, in fact.
Yeah, and I want to add what Lori Logan from the Dallas Fed and John Williams both said yesterday. And I think a big part of it is that both Williams and Logan are two people who you would.
So we're getting all this Fed speak. Really quick, if you haven't seen the charts, maybe some of you guys are. Look at this. Look at this bounce on the S&P. Look at this bounce on the S&P, right? Big sell-off. Oh my gosh. We're headed for a downturn. Now, hey, yes, this could turn around. Don't get me wrong. We could turn around and literally, let me just load the gap strategy. We could turn around. Wait, this ain't it. Damn, my thing is bugging out, yo. Dang, this thing is really bugging out right now. But for some reason, when I type in Tesla, it does work. SPY, it doesn't. All right, so this is what I was going to show really quick. Okay. We still need to fill the gap. I think we're going to fill this gap. Big gap down. Like we opened up, we gapped down. We got down almost a whole percentage. And then we basically sold off. That was extremely oversold. Like I thought we would bounce today because that's just too, there wasn't enough negative. Oh, just yields went higher. Okay. What is there any other risk? No, I don't think so. So we bounced. Now we're back to the highs. Doesn't mean we keep going up, but the fact that we're getting this bounce in the first place tells you there's dip buyers. It tells you there is strong dip buyers. And that's all you need to know for the macro going forward. And when we look at the actual candle, big hammer, right? Look at this big hammer candle. This big hammer, if it turns green, that's going to be very bullish. We're not talking about short term either. We're just saying holding the narrative. There are investors jumping in on this pullback, and it wasn't even a deep pullback. It was in the short term. Really just filled the gap to the downside. So we filled this gap at 438. Now we're moving back up. So I thought this would happen, which is, if we fill that gap, or not if we fill that gap, but I thought this would happen as in every pullback, we're going to see a strong buying coming into the market. Once we get the inflation data in, I think that's going to really determine what happens next when we get this next, because this might be the lowest print. This might be 2.9% inflation, maybe, right? Or low threes. Either way, the progress itself is going to cause FOMO. The progress on inflation alone will start to spark more FOMO. So I just want to point that out on the S&P. Nice recovery today. And the day's not over yet. We could literally roll over, go right back to the lows where there's more buyers. So there's a lot of traders in this market. But either way, that's a big bullish signal right there. Dang, yeah, this thing is bugging out. All right, back to the Steve Leisman. We might even turn green end of day. Yeah, we might. We might even turn green end of day.
Would expect to be very acutely attuned to what's going on in the banking sector. And neither seems particularly worried about it. There were essentially three things that might have stayed the Fed's hand when it came to raising rates so much. One was the lagged effects of monetary policy. Logan dismissed those. The second was trouble in the banking sector. Logan has dismissed that. The third was the idea of the Treasury rebuilding its account by $1 trillion and maybe taking some money and tightening up liquidity. Logan dismissed that, said none of that is really happening. She thinks we've sort of seen the lagged effects of tightening so far. And so her comment is we need to be raising rates. She would have raised them back in June, said, okay, I'm okay pausing here, but I want to raise them again and probably again. And what's happening today, guys, is this realization, I think, Williams yesterday, Logan today, the minutes yesterday as well, the strong ADP report, the strong ISM report, all of that saying, hey, you know what? Not only is the first rate hike on, which is the one coming in July, but the second one as well. There's the data we're talking about there. Jobless claims up, but not a whole lot. ISM services beating expectations. There's the non-farm payroll numbers. You have to worry, is that too light?
So ADP payroll, those are private payrolls, and they sort of give you a look into the future for the non-farm payrolls to some degree. Those almost doubled, more than doubled expectations. Like it's very strong. And a lot of this, I'm telling you, is government spending. Government spending is creating more jobs. Jobless claims down. Well, not down, but the estimate, it was above estimate. So yeah, people are losing their jobs and then they're finding other jobs. ISM PMI. This is what? Oh, services PMI. Yeah, services expanded. So very strong signal here for the economy. If you're not paying attention, we'll get new non-farm payrolls tomorrow. That's going to be very exciting to see how the market reacts. So now that we take a step back, what are we seeing? When we take a step back, we're seeing like, hey, the market actually responded good to this report. It is the bond yields that is responding negative to. You have a question there. I'm a little afraid of unemployment numbers tomorrow. What are you afraid of, Bescom? Are you afraid that they're too high or too low? Because right now the market has been responding kind of positive to higher unemployment because it means less Fed tightening. Lower unemployment also, I think, is going to be positive. And of course, it depends how you look at it, but I think that's also positive because it means that the Fed's not going to hike based on unemployment. They're not going to say, oh, unemployment's low, we got to hike. That's not what they do. If anything, they say unemployment's high, so we have to stop hiking, right? It doesn't work the other way. It is really the bond market that is tightening the market, not the Fed. The bond market's doing its job. If it anticipates higher inflation, the bond market is tightening. So the bond market's supposed to be doing the Fed's job anyway, generally, and it hasn't, but now it is. It's starting to do the Fed's job, which is good. That is literally interest rates for the market. Anyways, yeah. What are you worried about? Too low? You think they're going to be too low? Oh, I see. So you're worried that. Yeah, I don't think that's a thing, Bescom, because if unemployment is lower, that means the economy remains strong. So the Fed doesn't hike on that, but the bond market could tighten the way it did today. It could tighten the way it did today. Maybe it even moves higher. Maybe the bond market actually does move higher. Let me see what those yields are looking like right now. As the market does recover, I want to see how is the market recovering because yields are down? You guys can't see this, but wow, they broke out of that bull flag. Goodness sake. So is the bond market recovering because yields are down, or I'm sorry, is the stock market recovering because yields are rolling over, or because it's factoring in no risks? Okay, so yields did roll over, and that's why the market is also recovering. Yields rolling over. So I would say, hey, if we get strong employment tomorrow and bond yields move up, then yes, the market could pull back again. But like I said before, the Fed only makes a decision every 1 to 2 months when they have a meeting. So alone, the employment being strong isn't necessarily mean that they're going to hike rates, not off employment. It has to be those inflation numbers matching that, because the employment is part of their mandate. They want employment to be tight. It actually creates more productivity, right? With all the demand, it creates more productivity. So I think that's just false. I think it's false that unemployment being too strong is a bad thing. I don't think that is a bad thing, unless inflation is also carrying, if it's pushing up inflation, yes. But so far, we're not seeing that. We're not seeing it in the prices paid. We're not seeing that in services. So yeah, looking at that 10-year yield, it is coming down. We'll see how it comes out tomorrow. We'll be live again, 10 a.m. Eastern time tomorrow. All right, back to this report. We are falling far behind.
Relative to what might actually happen.
See what else we got up here before we actually tap out. Microsoft next to 3 trillion, threading the needle. Oil prices, wage growth decelerates from, yeah, wage growth is decelerating. All right, we're going to get back to the charts here. I don't know why my chart is messing up. That's weird. Fine, we'll go to the other charts. We'll just use the Thinkorswim charts. Or not Thinkorswim, I'm sorry, TradingView. All right, there we go, TradingView. Yeah, I was looking at the 2-year yield here. Yeah, nice bounce at the demand zone. Look at that. Nice bounce at the demand. S&P bouncing. We'll see if we can keep it up. But we're definitely not rolling over. Now we have a gap to fill up here. So now we really got to fill that gap. I do agree. AI is, yep, got all that down. We kind of went over time here, but that's fine. Let's take a look at what we have coming in tomorrow. And then I'll maybe go over some tweets. So tomorrow, 5:30 a.m. my time, which is 8:30 a.m. your time, we're going to get those non-farm payrolls. Right now, they're expected to come in somewhere between 225 to 250K. Okay, they're expected to come in that. If they come in, if they do another blowout, we could see those yields rise. We could, doesn't mean they will, or they could just remain elevated. Unemployment is expected to come in at 3.7 to 3.6. So that'll be big. That is 8:30 a.m. before the market, about 30 minutes before, oh no, I'm sorry, an hour before the market actually opens. Average hourly earnings. This is a big one. This is the wage inflation. This is what I'm worried about. If this goes up, then the market, if this trend ever starts to go back up, right? It's been going down. This is wage inflation. This is the actual wage inflation that people are worried about. Supply side inflation, wage pressures, whatever. Labor participation, that's been pretty elevated. That's good. So yeah, we got a lot of 5:30 a.m. data. We'll be going over this early morning. And then after that, we don't really have anything else. It's all labor data. And then we'll see how the market really reacts. It's Friday. This is good. There's nothing going to be, if you're looking at the market, we'll see nothing come into the market that is a surprise, because all the data comes out before, all the data will be coming out before that actually happens. So that is definitely something to look forward to, or that's actually something that's going to bring a little more clarity to the market. So, oops, didn't want to do that. So now we're looking at this zone up here. Pretty clear. We're just looking at zones for the S&P. 444.50. Yeah, we're looking at 444. That's the zone we're looking at, 444 for S&P. I think Qs look pretty similar. Oh, look at the Qs are already back above the opening print. So the Qs are responding a lot better. Qs already back above the open. Nice. Uh-oh. Yep, KRE. I think key chart right now is KRE regional. With yields rising, very inverted curve, it's max stress for small banks with bad balance sheets, 100% KRE. That's what we've been talking about, KRE. Question is whether the Bank of England have to do it first, or if the Bank of Japan needs to buy bonds. Okay. All roads lead to more cowbell. Ranveer, yes. The jobs report came out today. Part of it, it's today and tomorrow. So we have 2 jobs reports. Man, stop calling me. We have 2 job reports. We have today was private payrolls, okay, and job openings. Job openings are still declining. That's a positive. because we're still elevated. Job openings are still abundant, but the rate of change is coming down, which means it's closing the gap on wages. If companies, think of it this way, if there's a lot of job openings, then and a lot of people not coming into the workforce. Dang, I'm sorry. Excuse me. Got like a bubble. There we go. The more job openings come down, the more the wage inflation comes down also. Because if you have a lot of supply of jobs and nobody coming in, then basically employers raise wages to attract more workers. But if those jobs are closing and people are coming in, it's the opposite effect. It's not like an ironclad, like this is exactly what's going to happen, but that seems to be the thesis when it comes to wage inflation from the supply and demand dynamics in the labor market. So we saw job openings, we saw private smashed, private payrolls absolutely smashed. Like, I think that's just a signal that we're not going into recession. It's not going to happen. We're not going to see recession when it comes to the actual economy. The only way you get a recession is the Fed like just keeps hiking rates, and we see the recession in the second half or maybe the fourth quarter or Q1 of 2024. But I don't think they're just going to sit like, as long as inflation comes down, that's it. We're on a nice path. Anyways, I'm looking at KRE over here. This is really what the risk is here. The KRE index. KRE index. This is the risk. And I want to point out also that here's what really happens with KRE. Let's go over that daily chart. So KRE, net Fed liquidity. Oops. Fed net. Fed liquidity. Okay, just Fed liquidity. Did they change it on here? Heck. Did they remove this? There it is. I wonder if they removed. Weird. Well, I guess it's not on here. Net Fed liquidity. Usually I have it up. Usually you just put in Fed liquidity. Looks like they removed it, or maybe they changed the tickers. Either way, the point is that I'm making is like last time that the KRE index, which is a proxy for bank stress, last time it fell, we saw Fed liquidity shoot up. So if it does fall again, right, if we get this head and shoulders actually play out, if this head and shoulders does actually start to play out, and regional banking sector falls apart, and we move lower, start making new lows, expect the Fed to come back in. So I just don't think the risks are long term or not that bad in the short term. They could be bad in the short term, but not the long term. Oh, what type of job report comes out tomorrow? So tomorrow what we get is we really get the brunch. Like today we got like 25% of it. Tomorrow we get non-farm payrolls. This is the real benchmark payroll data that we want to see, non-farm payrolls. Okay. Just think of it as payrolls. So we get that tomorrow. Then we get unemployment, and then we get average hourly earnings, and then we get the labor participation rate. We get average weekly hours. That's another indication of labor data that's important. Government payrolls, manufacturing payrolls. But yeah, the big three, I would say, are unemployment rate, non-farm payrolls, and average hourly earnings, because we want to see that wage inflation along with it. Let's see. Oh shoot, I didn't know I didn't follow him. Uh-oh, oil's starting to move up a little bit. All right. Well, any questions before I get out of here? If you have any big questions, let me answer them real quick. We'll do some quick Q&A if you guys do have any questions. I'll give you a couple minutes to think about that. If you guys have any questions, I would love to answer before tomorrow. If not, I'm going to be here again, 10 a.m. Eastern time tomorrow, right? Ready for that, ready to report on the jobs report on the, and then try to put everything together. I would say today, when it comes down to it, right? Let me switch this up. When it comes down to it today, the real risk to the market, what we saw is that jobs came out really strong. Okay. The ADP private payrolls came out. This is just to sum everything up for today on the macro. What we got is private payrolls came in very strong, much stronger than expected. And bond yields started to spike. As a matter of fact, bond yields in the 2-year, which is the closest thing to the Fed funds rate, made a new high. And what that does is it increases the cost of capital for borrowing at a short term. The economy really runs off of borrowing debt. So the economy in general, or the markets in general, they get their growth generated from short-term debt, the 2-year, right? The 2-year. That's why when the 2-year went higher, it signals more expensive to fund that short-term growth. And so markets sold off initially. The S&P got smoked, big gap down, right? Q's, big gap down, everything sold off. And I said, well, you know what? Let's look at some other risks. Let's see if we find any other risks. So we looked around. Well, triple B spreads are still good. All right. Oil is not necessarily spiking. Okay, great. The 10-year isn't actually making new highs, but that's not really what's important. So what are the real risks? The labor market is strong. There is signaling no economic collapse. It's signaling no recession here. That's what we're seeing. The labor market being this strong, there's no recession fear. The recession fears are dissipating. So the real risk is, oh my gosh, employment is strong. The Fed's going to keep hiking. They're going to crash the economy, when really the Fed's narrative isn't about crashing the economy. It's about keeping inflation expectations low. And with the strong employment numbers, with people coming into the workforce, it actually doesn't make inflation go higher. What makes inflation higher is more lending at a lower rate, because people are going to spend more, right? If people have more jobs, you actually create more productivity, which literally lowers inflation, or keeps it tame to some degree, because you have more supply, more production, right? So really the risks aren't really there. We're not really seeing real risk. So the market bounced. So S&P is now bouncing. Now, to say that could roll over, so we might be wrong over the long term because we have more employment tomorrow. But I think it's just an opportunity to buy the dip. Yields are going higher. The cost of capital is up. Some algorithms probably triggered, and a lot of the S&P, a lot of the index sold off, and we had a nice bounce, and now we're right back up. Do we close the gap? Probably not. We need to get that data tomorrow. So I think tomorrow is going to be the deciding factor, whether to see how the market really digests a stronger than expected labor market. On the flip side, we got the services PMI, right? So what we're seeing is that the service economy is expanding, right? The ISM services, it is expanding. So services are expanding, and the prices paid, so the supply side inflation for services is falling. That is a perfect scenario. We saw the same thing in the ISM manufacturing report, which is new orders are going up, right? New orders are up. The prices paid are down. Inventories are falling, so people are actually buying. New construction is up. Construction month over month is up, which means building is happening. So really the backdrop is growth is returning, and the yields moving higher is just a result of expectations. And that might be good because it keeps a cap on the Fed. So, so really just to get today, growth is here. Growth is here to stay. I don't see any bit of collapse happening or any deceleration. And the market is also recovering. So I think it's just a buy the dip opportunity if for those mega caps or for whoever fell down. Now the real risk, here's the risk though. Here's the downside risk. Let's not make it all fun and games. The downside risk here is, and I'll get to your question, Hassan. The downside risk here is in the short term, because rates are elevated, it puts pressure on small caps, IWM, right? And particularly just look at that index. Small caps are risk assets that need funding, right? But if rates are higher, if the yields are higher to borrow capital, then it does put a lot of stress on them, because their earnings aren't now. They're not profitable. They make earnings in the future. Their bet is future expectations. So those yields hurt them. All right. Now the second risk is the KRE, the is basically the regional banking sector. The reason why we had a banking collapse last time, or a banking crisis, was because yields were so high, which means your actual collateral, because the yields is a reflection of how low your collateral is going. The yields go up, right? Because the yields is basically an interest rate. Interest rates go up as the collateral falls. Why? Because if your collateral is at risk, well, you're going to charge a higher interest rate for lending, right? Just to match the volatility of your collateral. So basically, banks, because they hold so much US treasuries and the US treasury market is selling off after this news, then you have banking, you have bank risk from the regional banks. JP Morgan, the big banks, too big to fail banks are fine. They're not going anywhere. They're going to be fine. It's the regional banks, right? Because their collateral is at risk. Their deposits, well, not their deposits have been at risk, but their collateral is at risk. So if they have to sell treasuries, they have the risk of becoming illiquid or insolvent, and that's the next risk. But again, it's a short-term risk because the Fed has a window that they lend to, the BTFP, the Bank Term Funding Program. So even if KRE rolls over, even if the banking sector, we start to see those issues come into the market, you can expect the Fed to step in with more liquidity. And that's pretty much the answer. That's pretty much where we're at. We'll get the labor market numbers tomorrow. I think we're still in a bull market. And let's go answer this last question. Any good entry point to add on NVIDIA and Tesla? My averages on these are 175 and 151. Don't want to move them up too much. I would say this, Hassan. Let's see if, because I'm waiting for this. Let's see if Tesla sells off. Right? I'm going to look at Tesla. Let's see if Tesla sells off going into earnings. So we have earnings in 2 weeks, right? A week and a half. And Tesla's been moving up strong, right? The delivery numbers are strong. So I would say this, just hold. And it really depends on how sized in you want to be. What is your size? Like, are you 100%? Are you 50% sized in? Are you 25% sized in? But definitely for Tesla, I would say the best entry point is if it closes the gap at 260, somewhere around 260, if it closes that gap before, between here and earnings. If not, if it doesn't, this is not financial advice. If this doesn't close the gap, let's see if it sells off into earnings. This could happen sometimes with Tesla. It might sell off going into earnings and wait for the report. Or the report happens, and after the earnings report, then it sells off, and then you can grab some more shares. Or you could just wait till earnings are done and wait for the price to be more patient. I would be a little more patient if I were you. I'd just stay patient. That's always the best way to move. You could be wrong though. The earnings could come out. It could just bid up, earnings come out, and it goes higher. So you could be 100% wrong, but guess what? You already have skin in the game. So you're already at a good entry point. Just wait for the giant pullback. Unfortunately, we just haven't had one. The last pullback was at 240, right? 241 was that last pullback. NVIDIA, on the other hand, NVIDIA, I would say, actually kind of like the setup on NVIDIA. NVIDIA is going to be the break of trend. I don't know when their earnings are, but we kind of pretty much know their trajectory for NVIDIA. So you're waiting for this break of trend. For NVIDIA, maybe at 400, somewhere around 405 to 400 could be another entry point. I'm trying to see what that volume looks like here. Yeah, I'd say like 400, somewhere around there. And always keep the overall market in mind, right? The more we consolidate, the bigger the breakout. So as the NVIDIA, right, as NVIDIA pulls in, not NVIDIA, but as the overall market pulls into these lows and finds support, that's where you want to be looking at the stocks you're most interested in. And as we get overall market support, you want to look at the support for your stock, because as the market moves higher, it's going to pull everything up. All right. Also, those inflation numbers come out next week. So we're going to stay day to day, right? We'll stay day to day. We'll look for more entries. You already know, if I see a good entry, I'm going to be like, all right, this is a good entry for a swing trade or for a hold. But right now, the last one, like I said, for Tesla was at that 240 break, around 240. That was the break above 240. For NVIDIA, I haven't really been paying attention. I'm more focused on AMD actually to see if AMD can stay. But yeah, that's all I have. Any other questions? Man, long stream today. My camera didn't actually burn out. This is interesting. So I got to figure that out. Yeah, we're going to end it here. So yeah, that was I think we went over everything. We'll be back in the morning. I think that's going to be more important. How do we keep responding to this? So I'll catch you guys in the morning, 10 a.m. Eastern. All right. I do appreciate the support from all of you guys who are on here. I'm trying to give you the best I possibly can. It seems like it's going good evaluating CNBC. We'll keep that up. We'll keep evaluating CNBC and give some feedback on it. Again, if you guys have questions, load up all the comments. Throw your questions out there. Give your comments. Don't be afraid to criticize me or my outlook. My response is just my passion. It's not anything personal. I do appreciate you guys jumping on. Make sure you guys stay blessed. I'm over here trying to get the music, and I'll try to get some better soundboard stuff. But anyways, let me see. How's this song? I like. Stay blessed. Stay blessed. We'll catch you tomorrow, 10 a.m. Eastern time.